Welcome everyone to Chapter 10, Maintaining Petty Cash Records. I'm very happy you are here because this chapter teaches you one of the most useful real office skills in accounting. It shows you how a business controls small cash payments, records them properly, and keeps the petty cash box balanced and safe. In this chapter, we will cover these main topics. Topic 1. The purpose of petty cash. We learn what petty cash is and why businesses keep a small amount of cash available. It is used for small everyday expenses that are quicker to pay in cash than by check or bank transfer. Topic 2. Security and control of petty cash. We learn how to protect petty cash from mistakes, loss, and theft. We also learn the basic rules of authorization, receipts, and checking the cash regularly. Topic 3. The imprest system. This is the most common system used for petty cash. We learn what imprest means and how the petty cash float stays at the same fixed amount after topping up. Topic 4. Petty cash vouchers. We learn what a petty cash voucher is and why it is so important. A voucher is the written proof that cash was paid out, including details like the reason, the amount, the date, and the person who received the cash. Topic 5. Recording and analyzing petty cash transactions. We learn how to record petty cash payments in the accounting records. This helps the business understand what the money was spent on and keeps the bookkeeping accurate. Topic 6. Recording petty cash transactions, including sales tax. Sometimes a petty cash receipt includes sales tax. We learn how to separate the tax part from the expense part so the accounts are correct. Topic 7. Topping up the float, balancing off, and posting petty cash. At the end of a period, the petty cash needs to be checked and balanced. Then the business prepares the top-up amount and posts the totals into the accounting system. By the end of Chapter 10, you will be able to run petty cash like a real accounts clerk. You will know how to pay correctly, record correctly, and keep everything controlled and organized. Okay, class, now we start Lesson 1. This lesson is about one very simple question. Why does a business keep petty cash at all? Petty cash means a small amount of cash kept on the business premises. It is usually kept as notes and coins. The money is kept in a safe place, مثل a locked cash box or a tin inside a drawer. The purpose of petty cash is to pay for small business expenses quickly. These are payments that are too small or too frequent to use the bank every time. So the main idea is this. Petty cash makes small payments easy. It saves time. It avoids unnecessary paperwork for tiny amounts. Now let us understand the problem petty cash solves. Imagine a business needs to buy one small item today. For example, a pen, or a notebook, or tea and coffee for the office. If the business uses the bank for every small item, it becomes slow and difficult, because paying through the bank often needs extra steps. You might need a check. You might need a bank transfer. You might need approval and signatures. You might need to wait for the payment to process. So petty cash is like a small emergency wallet for the business. It is there for quick, small payments. What kind of payments are normally paid from petty cash? Here are simple examples students can remember. 1. Small stationery items, pens, pencils, paper clips, stapler pins, and small notebooks. 2. Small office snacks and drinks, tea, coffee, sugar, milk, and water if the amount is small. 3. Small travel costs for work. For example, a bus ticket or a small taxi fare when someone is doing business tasks. 4. Small cleaning items, for example, a small bottle of cleaner or sponges. 5. Small postage or delivery costs, for example, stamps or a small courier fee. So the rule is very clear. Petty cash is for small amounts and regular small expenses. Now let us talk about something very important. Petty cash is not for big purchases. Petty cash is not for personal items. Petty cash is not for anything that looks suspicious or unclear. For example, buying a laptop is not petty cash. Buying office furniture is not petty cash. Buying a large monthly bill is not petty cash. Buying flowers for someone's personal occasion is not petty cash. Those types of payments should go through the main bank system. They need stronger control and better evidence. Now let's look at the responsibility part. Because petty cash is cash, it can easily be lost or stolen. So the business must control it properly. That is why petty cash is usually handled by one person. That person is called the petty cashier. This person keeps the cash safe. This person only pays out money for valid business reasons. This person keeps evidence for every payment. And this is why the book says the security of petty cash is the responsibility of the petty cashier. Because one person must be accountable, so we always know who's responsible for the cash. Now let us connect petty cash to accounting in a simple way. Every time petty cash is used, it is a business transaction. A transaction means something happened that affects the accounts. When we pay petty cash, two things happen. First, the business expense increases. For example, stationery expense increases. Second, cash decreases because cash has been paid out. So petty cash is not just about paying, it is also about keeping correct records. Even small payments matter in accounting because small payments add up over time. If we ignore them, the accounts will be wrong. Now I want you to remember one key sentence. Petty cash is a small controlled amount of cash kept to pay small business expenses quickly while keeping proper evidence and records. That is lesson 1. In the next lesson, lesson 1.1, we will go deeper. We will talk about what items are paid out of petty cash and what items should never be paid out of petty cash. 1.1. What items are paid for out of petty cash? All right, class. Now we go to lesson 1.1. This lesson answers a very important question. What types of things can a business pay for using petty cash? Remember, petty cash is a small amount of money kept in the business for small payments. So the items paid from petty cash must also be small items, and they must be business items, not personal items. So the items paid out of petty cash are usually small everyday expenses that happen in an office. Let us break it down carefully, like we are sitting in a real classroom. Part 1. The basic rule. The basic rule is this. Petty cash payments should be for small items of expense, where payment in notes and coins is needed. That means two things. 1. The item is small. 2. It is easier to pay by cash than using the bank. For example, it would be strange to make a bank transfer for one small box of paper clips. So petty cash is perfect for that. Part 2. Different businesses have different rules. Now students, listen to this part carefully because it is very common in real life. Different organizations have different rules about what can be paid out of petty cash. One company may allow certain items. Another company may not allow those same items. Why? Because each business decides what is safe and reasonable for them. Also, many businesses will write a list of what can be paid from petty cash. This list is called an official list of allowable items. This list helps in 3 ways. 1. It tells staff what they can request. 2. It helps the petty cashier make decisions easily. 3. It reduces mistakes and reduces fraud. Part 3. Example of typical petty cash items. Now let us look at the common items that are usually allowed. These are the small expenses you often see in offices. 1. Stationery and office supplies. This includes things like pens, pencils, erasers, paper, stapler pins, files, and envelopes. 2. Small cleaning and maintenance items. For example, a small bottle of cleaning spray, a cloth, or basic cleaning materials. 3. Small travel and transport expenses for work. For example, bus fares, train tickets, or small taxi costs when an employee is traveling for business tasks. 4. Postage and small delivery costs. For example, stamps or a small local delivery charge. 5. Small refreshments for business use. For example, tea, coffee, sugar, or milk for the office. 6. Very small urgent purchases. For example, if something runs out suddenly and it must be bought immediately, petty cash can be used if the amount is small. So you can see, the items are small, regular, and business-related. Part 4. What items should not be paid by petty cash? Even though Lesson 1.1 focuses on what can be paid, it is also important to understand what should not be paid. Because many mistakes happen here. Petty cash should not be used for large items. For example, these are not petty cash items. A new chair for the office, a printer, a computer, big repairs, large monthly bills such as rent or electricity. Those payments should go through the main bank system. Also, petty cash should not be used for personal items. For example, a birthday gift for an employee, personal groceries, personal flowers, personal taxi rides. These are not business expenses, so petty cash should not pay for them. Part 5. Some businesses do not have an official list. Now, this is also mentioned in the lesson. Not all businesses have a policy of providing an official list of allowable items for petty cash. That means sometimes the company has no written list. In that situation, the petty cashier and the supervisor use judgment. Judgment means they decide based on what seems reasonable and business-related. But students, this is very important. Using judgment can be risky because when rules are not written, people can argue, people can misunderstand, and it becomes easier for someone to misuse the petty cash. That is why many businesses prefer to have a clear list and clear limits. Part 6. The key idea you must remember. If you remember only one thing from lesson 1.1, remember this. Petty cash is for small business expenses that are convenient to pay using cash, and the business may set rules or a list to control what is allowed. That is the full meaning of this lesson. Now, in the next lesson, lesson 1.2, we will discuss another important question. Who gets paid out of petty cash? Meaning, who is the direct receiver of the cash? 1.2. Who gets paid out of petty cash? All right, class. Now we are in lesson 1.2. This lesson is very important because it explains one simple idea. When petty cash is used, who actually receives the cash? In real life, petty cash is held by the petty cashier. The petty cashier is the person in charge of the small cash box or petty cash tin. When someone needs a small payment, they come to the petty cashier. Now let us break this lesson into clear parts. Part 1. Two types of people can receive petty cash. Payments out of petty cash are usually made to one of these two groups. Group 1, employees. Group 2, suppliers. That is the core message of this lesson. Part 2, payments to employees. Many petty cash payments are paid to employees. But why do we give petty cash to employees? Because employees often spend their own money first. Then the business reimburses them. Reimburse means pay them back. Let us use a simple example. An employee buys office stationery from a nearby shop. Maybe they buy pens, paper, or stapler pins. They pay using their own money because it is quick. Then they bring the receipt to the office. Then the petty cashier gives them cash from petty cash. This cash is to refund the employee. So the employee is the person who receives the cash. But the expense is a business expense. Another example. An employee pays a taxi fare for a small work trip. They bring proof like a taxi receipt. Then petty cash refunds the employee. So remember this clearly. When we pay an employee from petty cash, it is usually a reimbursement. It means the employee already paid first. Now the business is paying them back. Part 3. Payments directly to suppliers. The second group that can be paid out of petty cash is suppliers. A supplier is an outside person or business that provides goods or services. Sometimes the supplier comes to the office, and the business pays them immediately using cash. For example, a milk delivery person may deliver milk to the office. The business may pay the milk delivery person using petty cash. Another example, a window cleaner may come and clean the office windows. The business may pay the window cleaner using petty cash. So here the cash goes directly to the supplier. This is different from the employee reimbursement example, because the supplier is being paid directly. Part 4. Why petty cash can be paid to these two groups only. Now I want you to understand the reason behind this rule. Petty cash is designed for small, everyday payments. Those payments happen in two main ways. One way is paying back an employee for small expenses they already paid. Another way is paying a small supplier bill immediately in cash. That is why the book focuses on employees and suppliers. It makes petty cash simple and controlled. Part 5. What the petty cashier must check before paying if. Even though this lesson is about who gets paid, we must also think like accountants. Before giving out petty cash, the petty cashier should check a few things. 1. Is the payment for business reasons? 2. Is the amount small enough for petty cash rules? 3. Is there evidence, like a receipt, invoice, or proof of purchase? 4. Is the payment authorized, meaning approved by the right person? This is how we protect the petty cash from misuse. Part 6. A common real-life situation. Sometimes an employee has not bought the item yet, but they need cash first to go and buy it. For example, an employee must quickly go to a shop to buy envelopes or stamps. They do not have enough money with them, so they ask the petty cashier for cash first. In this situation, the employee receives the cash. Then they must return with a receipt, and they must return any change if there is extra money left. So petty cash can be used in two employee situations. 1. Reimbursement, which is paying back after they already spent. 2. Advance, which is giving them cash before they spend. But the key point stays the same. The employee still receives the petty cash. Part 7. The main lesson to remember. Now let us say the main point in a very simple sentence. Petty cash is paid either to employees, usually as reimbursement for small expenses, or directly to suppliers for small cash payments. 1.2.1. Watch out for taxes and benefit contributions for casual labor. All right, class. Now we're going to study Lesson 1.2.1. This part is a warning. It tells us to be very careful when petty cash is used to pay casual workers. Let us go step by step, like a teacher in a real classroom. 1. What does casual labor mean? Casual labor means temporary work. It is not a full-time employee job. It is usually paid by the day, or by the week, or by each small job. Examples of casual labor can be an office cleaner who comes once a week, a helper who carries boxes for one day, a person who does a small repair job quickly. So casual labor is work done by a person, and the business pays that person for their time. 2. Why is this a special warning in petty cash? Many businesses think like this. It is a small payment, so let us just pay from petty cash. It is easier and faster. But the book warns us. This is not only an accounting issue. This is also a tax and legal issue. Because when you pay a person for work, the government may treat it like wages. Wages are normally connected to taxes and employee benefits. So even if the amount is small, the rules can still apply. 3. What is the tax problem? When a business pays someone for labor, the tax authority may want to know, who is the person? How much were they paid? What work did they do? How often are they paid? In many countries, if you pay someone for working, you may have to deduct payroll taxes. Report the payment properly. Keep official records. So the danger is this. If petty cash is used carelessly, it can look like hidden wages, and hidden wages create serious problems for the business. 4. What are benefit contributions? In many systems, when wages are paid, there may also be contributions. These are extra costs connected to employment. Examples are national insurance contributions, social security payments, employment insurance contributions, pension-related contributions. The exact name can change by country, but the idea is the same. The government may require extra payments when someone is treated as a worker. That is why the book says taxes and benefit contributions. 5. The key message of this lesson. The key message is simple. Paying casual labor from petty cash can create tax and legal responsibilities. So do not treat it like a normal small expense. Treat it like a payment to a person for work. 6. A very clear example to understand. Imagine this situation. Your business has a cleaner. The cleaner comes every week. The cleaner is paid a weekly amount in cash. The petty cashier gives the cash from petty cash. This looks simple, but it can cause questions later. For example, is this cleaner an employee or not? Should payroll taxes have been deducted? Should the business have official records? Does the business owe contributions as well? So even though it is small cash, it can become a big problem. 7. What the book advises you to do. The book gives a clear instruction. Payments out of petty cash for casual labor should be officially approved. It says the payment should be sanctioned by an office manager. Sanctioned means approved and authorized, so the petty cashier should not just pay it automatically. 8. What information should be kept payee? When paying casual labor, good records are essential. A business should keep details like the person's full name, the person's address, the date of the work, the type of work done, the amount paid, a signature from the person receiving the cash, if possible, any supporting document if available. This creates evidence. It also shows that the business is not hiding anything. 9. What is the safest approach? The safest approach is this. If casual labor payments happen regularly, do not keep paying from petty cash. Instead, pay through proper systems such as payroll, bank transfer, cheque, an official supplier invoice if the worker is a contractor. This helps the business stay compliant. It also protects the petty cashier. 10. Final classroom summary. Let me summarize Lesson 1.2.1 in a very easy way. Petty cash is for small items and small expenses. But paying people for work is different. Even small cash wages can create tax responsibilities. So casual labor payments must be authorized by a manager, and detailed records must be kept. That is the full meaning of Lesson 1.2.1. students. Let us look at the question and then understand the answer step by step, like we are in a real classroom. Lesson 1.2.1 question. The question is asking this. We are working in the company called Top Toys. We want to pay some items using petty cash. The question gives you 4 different payments. For each payment, you must decide one thing. Is it acceptable to pay this item using petty cash or not? So you are checking 3 main rules at the same time. Rule 1. Petty cash is only for small amounts. Rule 2. Petty cash must be for business expenses, not personal items. Rule 3. The payment must make sense for petty cash, not something big or unusual. Now let us explain the answer, item by item, in the same order as the question. Item 1. Portable air conditioning unit. Amount is $75.99. Paid to Steve Gray, office manager. Answer is not acceptable. Why it is not acceptable? First reason, the amount is too high for petty cash. Petty cash is for small payments. This is a large amount. Second reason, a portable air conditioning unit is not a small daily expense. It is more like equipment for the office. Equipment should usually be paid through the normal bank payment system, not petty cash. For example, by check, bank transfer, or company card. So the answer says no because the amount is too high. Item 2, coffee filters for office coffee machine. Amount is $2.99. Paid to Asif Sultan, PA. Answer is acceptable. Why it is acceptable? First reason, the amount is very small. $2.99 is exactly the kind of size petty cash is used for. Second reason, it is a business item. The coffee machine is in the office. Coffee filters are a normal office supply. Third reason, it is normal for an employee to buy small office items and then get reimbursed from petty cash. So the answer says yes. Item 3, bunch of flowers for Valentine's Day. Amount is $18. Paid to Nick King, sales. Answer is not acceptable. Why it is not acceptable? Even though $18 is not a big amount, this is the key problem. This is a personal item. Flowers for Valentine's Day are not a necessary business expense for the company. Petty cash must be used only for valid business reasons. If the company pays for personal gifts, it can lead to misuse of petty cash. So the answer says no because it is a personal item. Item 4. Bus ticket to Plastics Today conference. Amount is $2.60. Paid to Nick King, sales. Answer is acceptable. Why it is acceptable? First reason, the amount is small. $2.60 is a typical petty cash payment. Second reason, it is a business reason. The employee is traveling for a work conference. Travel costs for work are business expenses. Third reason, paying small travel costs like bus fares from petty cash is very common. So the answer says yes. Final classroom summary. So students, the main idea is very simple. Petty cash is for small business expenses only. If the amount is too high, it is not petty cash. If the expense is personal, it is not petty cash. If the expense is small and for work, it is usually fine for petty cash. Students. Now we move to Lesson 2 in Chapter 10. Lesson 2 is called Security and Control of Petty Cash. This lesson is very important because petty cash is real physical money. It is notes and coins. That means it can be lost easily, it can also be stolen easily, and it can be misused easily. So the main purpose of Lesson 2 is this: to make sure petty cash is used correctly, to make sure petty cash is safe, to make sure every petty cash payment is approved and proved. Let me explain this lesson like a classroom lecture. Lesson 2. What does security and control mean? Security means keeping the petty cash safe, so nobody can steal it, and nobody can take it without permission. Control means having rules and checks, so every payment is for the business, and every payment is recorded properly, and every payment can be checked later. So remember this simple sentence: security protects the cash, control protects the company records. Why petty cash needs strong security and control? Petty cash is different from bank payments. Bank payments leave a trace in the bank. Checks have numbers. Bank transfers have references. Card payments appear on statements. But petty cash is physical cash. If it is taken without recording, it can disappear, and it can be difficult to prove who took it. So without good control, petty cash becomes dangerous. The biggest risks with petty cash. In real life, these are the common problems. 1. Cash can be stolen. 2. Cash can be taken for personal use. 3. People can claim cash without a real business reason. 4. People can claim cash without a receipt. 5. Fake receipts can be used. 6. Amounts can be written wrongly. 7. Payments can be made but not recorded. So Lesson 2 tells us how to stop these problems. The golden rule of Lesson 2. This is the key rule you must always remember. Every petty cash payment must be properly authorized, and every petty cash payment must be supported by evidence. Evidence usually means a voucher and a receipt. So the company must be able to answer 2 questions every time. Why did we pay this cash? Who approved this cash payment? If the company cannot answer these 2 questions, then the payment is not controlled. What authorized means in petty cash, authorized means approved by the right person. So the petty cashier should not just give cash to anyone. Before paying cash, the petty cashier must make sure the expense is a valid business expense. The amount is within the petty cash limit. The correct person has approved it. For example, the company may say, up to $10 can be approved by a supervisor. Above $10 must be approved by a manager. Different companies can have different rules, but the idea is always the same. Do not pay cash without approval. What evidenced means in petty cash. Evidenced means there must be proof. The normal proof is 2 things, a petty cash voucher and a receipt. The voucher explains what the money was for. The receipt proves that the item was really bought, so the voucher and receipt work together. Voucher explains the reason, receipt proves the purchase. Why signatures are important in petty cash. Lesson 2 also explains that vouchers should be signed. Usually, 2 signatures are needed. Signature 1, the person receiving the cash. Signature 2, the person authorizing the payment. This is very important because it creates responsibility. If someone signs, it means they accept the payment is correct. So later, if there is a problem, the company can investigate properly. Keeping petty cash physically safe. Security is not only about documents, it is also about physical protection. A good petty cash system normally includes these rules. Keep petty cash in a locked cash box or locked tin. Keep the cash box in a safe place, like a locked drawer or cabinet. Only the petty cashier should have the key. Do not leave the cash box open on the table. Do not let many people access the cash box. Because if too many people can touch it, then no one is accountable. Controlling petty cash with regular checking. Even with vouchers and receipts, we still need checking. The company should regularly count the cash in the box, and the company should compare it with the records. This is how we confirm everything is correct. So you check 3 things. Cash in the box, vouchers for payments made, total of payments recorded. These checks help you find mistakes quickly. They also discourage theft because people know the cash will be counted. Lesson 2, the simple control story. Let me tell you the whole lesson in one simple story. Step 1, someone requests petty cash. Step 2, the request is approved by the correct person. Step 3, a voucher is prepared. Step 4, the petty cashier pays the cash. Step 5, the person receiving cash signs. Step 6, a receipt is attached when possible. Step 7, the payment is recorded. Step 8, later, the cash is counted and checked. This is security and control in action. End of Lesson 2 summary. So students, Lesson 2 teaches us these key points. Petty cash must be protected because it is physical cash. Every payment must be authorized. Every payment must be evidenced using a voucher and usually a receipt. Signatures create responsibility and reduce misuse. Cash must be kept locked and access must be limited. Regular checking makes the system reliable and safe. That is Lesson 2. Next, we will go into Lesson 2.1, which is about the petty cashier. Lesson 2.1. The petty cashier. This lesson is about the person who is responsible for petty cash. And this is very important because petty cash is real physical money. So the petty cashier must be careful every day. Lesson 2.1. Who is the petty cashier? The petty cashier is the person in the business who keeps the petty cash money, gives out small cash payments when approved, records every petty cash payment properly. So you can think of the petty cashier like this. The petty cashier is the keeper of small cash in the office. They are trusted to look after it and control it. Sometimes there can also be a deputy petty cashier. That means a backup person who helps when the main petty cashier is absent. The main duties of the petty cashier. The book gives 3 main responsibilities for the petty cashier. Let us explain each one like a teacher in class. Duty 1. Keep the petty cash in a safe place. This is the security part. The petty cashier must make sure the cash is protected, because if the cash is not safe, it can disappear. So the petty cashier must do things like these. Keep the cash in a locked petty cash box. Keep that box inside a locked drawer or cabinet. Keep the key secure and private. Do not leave cash on the desk. Do not allow other people to open the cash box. Why is this important? Because if many people can access the cash, nobody will be responsible. And when something goes missing, it becomes impossible to find the truth. So remember this rule. Only the petty cashier should have control of the cash box. Duty 2. Make the actual cash payments. This is the operational part. The petty cashier is the person who physically gives the money. But the petty cashier must not pay cash like a friend doing a favor. It must be a business process. So the petty cashier must pay only when there is a valid request. A valid request means the payment is for the business. The payment is small enough to be allowed as petty cash. The payment follows the company rules. Example to understand this clearly. Imagine a staff member buys pens for the office. They paid from their own pocket. Now they want to be reimbursed. The petty cashier should not just give cash immediately. The petty cashier should first check. Is it a business item, like pens for work? Is the amount within the petty cash limit? Is there a receipt or proof of purchase? Is there approval from the right person? Then and only then the petty cashier pays the cash. This makes petty cash professional and controlled. Duty 3. Ensure payments are properly authorized. This is the control part. This duty is very powerful because it prevents misuse. Properly authorized means the payment is approved by the correct person in the business, not just approved by the person who wants the money. So the petty cashier must always ask, who approved this payment? For example, if the rules say that only a supervisor can approve travel expenses, then the petty cashier must see the supervisor's approval first. If there is no approval, the petty cashier must refuse the payment. Even if the person asking is in a hurry, even if the person is angry, because without approval, petty cash can become a big problem. So remember this sentence. The petty cashier pays cash, but the petty cashier does not decide on their own. What documents the petty cashier should keep? To keep control strong, the petty cashier must keep evidence. Usually, the petty cashier should have a petty cash voucher for each payment, a receipt attached to the voucher whenever possible, signatures from the person receiving the cash, signatures from the person authorizing the payment. So later, if a manager checks petty cash, everything is clear. What was paid, who received it, who approved it, why it was paid, why this role reduces fraud and mistakes. This lesson connects directly with real business safety. If the petty cashier does their job properly, it reduces cash theft, personal spending using business cash, fake expense claims, payments with no proof, payments that should have been paid by another method. It also helps the business stay organized because petty cash is small amounts, but many payments happen often. If you do not control it, it becomes messy very quickly. Lesson 2.1. Quick summary for students. Let us close this lesson with a simple summary. The petty cashier is responsible for petty cash. The petty cashier keeps petty cash secure and locked. The petty cashier makes cash payments only for valid business reasons. The petty cashier checks that payments are properly approved. The petty cashier keeps documents, vouchers, receipts, and signatures. So students, the petty cashier is not just a person holding money. The petty cashier is a key control person in the business. Next, we will go to lesson 2.2, which is the petty cash box. Now we are learning lesson 2.2, the petty cash box. This lesson is about one simple thing. Where do we keep petty cash money and how do we keep it safe? Petty cash is real cash. It is notes and coins, so it can be lost easily or it can be stolen easily. That is why the petty cash box is very important. Lesson 2.2, what is the petty cash box? The petty cash box is a small box or a small tin that holds petty cash. Inside the petty cash box, you will usually find notes, like $20 notes or $10 notes, coins, like $1 coins and smaller coins, receipts and petty cash vouchers, depending on the system used. So the petty cash box is like a small mini bank for the office, but it is not a normal box. It must be a lockable box. Why must the petty cash box be lockable? Because petty cash is easy to take. If the box is open, anyone can take money. Even small amounts can disappear little by little, and then at the end of the week, the cash will not match the records. So the rule is, petty cash must be kept in a lockable box or tin. Where should the petty cash box be kept? The petty cash box should not be left on the desk, and it should not be left in an open place. The petty cash box should be kept in a locked drawer, or in a locked cabinet, or in another safe place, like a small office safe. So we have two levels of protection. First protection is the lock on the petty cash box. Second protection is the locked drawer or cabinet. This is much safer than leaving cash in the open. Who should hold the keys? The petty cashier should hold the keys. That means the petty cashier should keep the key to the petty cash box. The petty cashier should also keep the key to the drawer or cabinet if needed. This is important for control, because if many people have the keys, then nobody is fully responsible. Who is allowed to access the petty cash box? Only the petty cashier should access the petty cash box. Sometimes there is also a deputy petty cashier. That is a backup person. They can help only when the petty cashier is absent, but normally the rule stays very strict. One main person controls petty cash. This is a control rule. It prevents confusion. It prevents theft. It prevents arguments later. What is a bad procedure and why it is dangerous? Sometimes in some offices, more than one person has access. For example, someone keeps the petty cash box at reception, and several staff members can open it, or staff members borrow from it without asking. This is a very weak system. Why is it weak? Because it creates these problems. People can take cash without permission. People can forget to record the payment. Receipts may not be collected. The cash balance becomes incorrect. You cannot easily find who made the mistake. So the lesson is teaching us this. If too many people touch petty cash becomes unsafe. A simple classroom example. Imagine the petty cash box has $100 inside. Now imagine 3 people have access to the box. Person 1 takes $5 for parking. Person 2 takes $10 for taxi. Person 3 takes $3 for snacks. But nobody writes it down. Nobody brings a receipt. At the end of the day, the box is missing $18. Now, the business has a problem. The money is gone. There is no proof, and nobody knows exactly what happened. This is why the petty cash box must be controlled by one responsible person. What lesson? 2.2 is trying to teach you. This lesson is not only about the box. It is teaching a bigger accounting idea. The idea is called internal control. Internal control means we protect the business money. We make sure money is used correctly. We make sure every payment is recorded. We reduce fraud and mistakes. So the petty cash box is a small part of business security, but it is a very important part. Quick summary for students. Let us summarize Lesson 2.2 in a simple way. The petty cash box holds petty cash notes and coins. The petty cash box must be lockable. It should be kept in a locked drawer or cabinet. The petty cashier should control the keys. Only the petty cashier, and maybe a deputy, should access it. Allowing many people to access petty cash is a poor procedure. Great work, students. Now that we understand the petty cash box, we are ready to move forward to the next part. Now we are doing Lesson 2.3. Lesson 2.3 is called, Why Are Only Small Items Paid For Out of Petty Cash? This is a very important rule in petty cash control. Petty cash is not meant for big payments. Petty cash is only meant for small, everyday payments. Let us understand why, step by step, like a real classroom lesson. First, what does small items mean? Small items means small office expenses that happen often. For example, a small bus ticket, small postage stamps, a small pack of pens, a small notebook, a small emergency item from a local shop. These items are usually cheap. They are usually needed quickly, and it is not convenient to pay by check or bank transfer for them. That is exactly why petty cash exists. Now the main question, why do we not use petty cash for large expenses? For example, why do we not use petty cash to pay for office furniture, a big restaurant bill, plane tickets or travel bookings, large repairs, large purchases for the business? The book gives 2 big reasons. Let us explain them slowly and clearly. Reason 1. Large cash payments are an obvious target for theft. When a large amount of cash is kept in the petty cash box, it becomes dangerous. Think about it. If the petty cash box has only a small amount, it is less tempting. But if the petty cash box has a large amount, it becomes a big temptation. Also, if something goes missing, a small missing amount might not be noticed quickly, but a large missing amount becomes a serious loss for the business. So the rule is, we keep petty cash small, so the risk of theft stays low. That is one of the main reasons. Reason 2. The business must monitor spending and control payments properly. Large payments must be controlled more carefully. Large payments need proper approval from the right manager, proper documents like invoices and purchase orders, proper checking like making sure the goods were received, proper recording in the accounting system. If we pay large expenses using petty cash, we can bypass these controls, and that causes big problems. Here are the problems that can happen. 1. The payment may not be approved correctly. 2. The receipt or invoice might be missing. 3. The payment might be recorded wrongly. 4. Someone can misuse the money more easily. 5. Fraud becomes easier to hide. So petty cash is not only about paying quickly. Petty cash is also about keeping control. When the amount becomes large, petty cash is no longer safe as a method. A simple classroom example. Imagine an employee says, "I need cash to buy office chairs." Office chairs are not a small item. Office chairs are a large business purchase. If the petty cashier gives cash for that, there might be no proper supplier invoice. There might be no proper approval. The price might be higher than normal. The business cannot control the purchase properly. So the correct system is use the main bank account system. Use a check, bank transfer, or company card, and follow the proper purchasing process. What petty cash is really designed for? Petty cash is designed for speed and convenience, but only for small payments. It is used when the amount is small, the payment is urgent. The normal payment methods are not practical. That is the correct use of petty cash. So what should we use for large payments? For large payments, businesses should use safer and more controlled methods. For example, bank transfer, check, company credit card, payments through the normal accounts payable system. These methods leave a clear record. They also require proper approval, and they reduce the risk of theft and misuse. Very important point for exams. In exams, if you see a question that asks, "Why is petty cash used only for small items?" your answer must include these key ideas. Petty cash should stay small to reduce theft risk. Large cash amounts attract theft and are unsafe. Large payments must be monitored and controlled properly. Petty cash for large items can lead to abuse, dishonesty, and errors. That is the full meaning of Lesson 2.3. Quick summary for students. Let us finish with a clean summary. Petty cash is only for small items. Large cash amounts increase the risk of theft. Large payments need stronger controls and approvals. Using petty cash for large items can cause fraud, misuse, and mistakes. So large payments should go through the main business payment system. 2.4 is called Limiting the Size of Petty Cash Payments. Students, this lesson is very important because it explains one of the main rules of petty cash. Petty cash is only meant for small payments. So every business must set a maximum limit for one petty cash payment. What does maximum limit mean? It means there is a biggest amount that the petty cashier is allowed to pay at one time from the petty cash box. For example, a company may say this rule: one petty cash payment must not be more than $40. So, if a person asks for $50 from petty cash, the petty cashier must not pay it. Why do we need a limit for petty cash payments? We need a limit because petty cash is not safe for large payments. Here are the main reasons. Reason 1. Safety and theft risk. If we allow big payments from petty cash, too much cash will leave the box. That makes it easier for money to be lost or stolen. Reason 2. Better control for big payments. Large payments should go through stronger control systems. For example, bank transfer, check, or company card. Those methods leave a clear record in the bank and in the accounting system. Reason 3. Easier checking and monitoring. Small petty cash payments are easier to track. But if we pay large amounts from petty cash, the petty cash records become messy. Then it becomes harder to check if everything is correct. Reason 4. Petty cash is designed for small items. Petty cash is for small everyday expenses. For example, small stationery items, small travel costs, or small urgent purchases. It is not for expensive items. What should the petty cashier do if the amount is too high? If a request is above the petty cash limit, the petty cashier should do two things. First, refuse the petty cash payment politely. Second, tell the person to use another payment method. For example, they can use a check, a bank transfer, a company credit card, an expense claim that is paid properly through the accounts department. Important warning for students. Never try to break one big payment into two smaller petty cash payments. That is wrong. It is done to escape the limit and it damages the control system. Simple examples to make it clear. Example 1. A person asks for $12 for pens and paper. This is small. This is acceptable for petty cash. Example 2. A person asks for $75 for a portable air conditioning unit. This is a large amount. This is not acceptable for petty cash. It must be paid using another method. Example 3. A person asks for $45 for a business expense. If the limit is $40, we do not pay it from petty cash. Even if it is only $5 more, the rule still applies. Final message to remember. Lesson 2.4 teaches one clear rule. Petty cash is for small payments only, so we must set a maximum limit for each payment, and anything above the limit must be paid using another proper payment method. 2.5 is called Authorization and Authorization Limits. Students, this lesson is one of the most important controls in petty cash. Because petty cash is real money sitting in a box, the business must control who is allowed to approve payments and how much they are allowed to approve. Let us explain it step by step in a simple classroom way. What does authorization mean? Authorization means permission. It means someone with authority says, yes, this payment is allowed. Only then the petty cashier should pay the money. So the petty cashier does not just pay because someone asks. The petty cashier pays only when the payment has been properly approved. What does authorization limit mean? An authorization limit means the maximum amount a person is allowed to approve. For example, a company may set these limits. The petty cashier can approve payments up to $20. The supervisor can approve payments up to $40. The manager can approve payments above $40. So if someone wants $30, the petty cashier cannot approve it. The supervisor must approve it. This rule protects the business. It also makes sure no one person has too much power over cash payments. Why do we need authorization limits in petty cash? There are 4 big reasons. Reason 1, to stop fraud. Fraud means someone tries to take money dishonestly. If payments are always approved, it becomes harder for someone to steal. Reason 2, to stop mistakes. Sometimes mistakes happen. Maybe someone writes the wrong amount. Maybe the expense is not business related. Approval reduces these errors. Reason 3, to make sure payments are for valid reasons. Valid means the expense is real, business related, and necessary. Reason 4, to keep good control and discipline. If everyone knows they must get approval, people become more careful. They will not request money for things that are not allowed. How authorization works in real life. Imagine the petty cash box is like a small bank inside the business. The petty cashier is like the person working at the counter. Now let us see the correct process. Step 1. Someone wants petty cash for a small business expense. Step 2. They must provide a receipt or explain what they need the money for. Step 3. A petty cash voucher is prepared. The voucher shows details like what the payment is for, the amount, the date, who is receiving the cash. Step 4. The payment must be approved by the correct person. This depends on the authorization limit. Step 5. Only after approval, the petty cashier gives the cash. Step 6. The voucher and the receipt are kept as proof and evidence. What can the petty cashier approve? In many businesses, the petty cashier is allowed to approve only small payments. This is usually for items such as small office supplies, minor travel costs like parking, small emergency items. But there is an important condition. The petty cashier can only approve small payments when the person provides proof. Proof usually means a receipt. So you should remember this rule. No receipt, no automatic petty cash payment. Unless a supervisor approves it. What happens when the payment is bigger than the petty cashier's limit? If the amount is above the petty cashier's limit, the petty cashier must not pay it. Instead, one of these must happen. Option 1. The payment is approved by the petty cashier's supervisor. Option 2. The payment is approved by a nominated individual. A nominated individual means a person chosen by the business to approve payments. For example, a senior staff member. Option 3. The payment is sent to the manager for approval. This is the correct control system. What happens in exceptional cases? Sometimes a payment is urgent and unusual. This is called an exceptional case. For example, an emergency repair is needed. A special urgent delivery cost appears. Something essential is needed immediately. In these situations, petty cash may still be paid, but only if a senior person approves it. So the key idea is, the bigger and more unusual the payment is, the higher the approval must be. Simple examples to make it easy. Example 1. Sarah asks for $10 to buy printing paper. This is small. If the limit is $20, the petty cashier can approve it. A receipt should be provided. Example 2. Ali asks for $35 for a taxi fare. If the petty cashier limit is $20, this is too high. The supervisor must approve it first. Example 3. Someone asks for $60 for an item. This is too high for petty cash in most businesses. It should be approved by a senior person or paid through the main payment system. The main lesson you must remember. Lesson 2.5 teaches one strong control rule. Petty cash payments must be properly authorized, and every person has an authorization limit, so no one can approve any amount they want. This keeps petty cash safe. This keeps the business protected, and it keeps the records correct and trustworthy. Lesson 2.6 is called receipts. Students, this lesson is about one very simple idea. If you take cash from petty cash, you must bring proof. That proof is the receipt. A receipt is one of the strongest controls in petty cash because petty cash is real money and it can easily be misused if there is no evidence. What is a receipt? A receipt is a document that proves a purchase happened. It proves 3 main things. 1. Something was bought. 2. Money was paid. 3. The purchase was made from a specific supplier on a specific date. In petty cash, the receipt is the evidence that the payment was real and allowed. Why receipts are so important for petty cash? Let us think like an auditor for a moment. If you open a petty cash box and see that money is missing, you will ask one question. Where is the proof for each payment? That proof is the receipt. Receipts are important because they 1. Prevent fraud. A person cannot just take money and say, I spent it. They must prove it with a receipt. 2. Reduce mistakes. The receipt shows the correct amount, so the petty cashier does not guess the amount. 3. Confirm the payment is business-related. The receipt helps confirm it is not personal spending. 4. Support good accounting records. Later, the accounts department will record the expense. They need the receipt details to record it correctly. How receipts are used in the petty cash process. Let us walk through the normal process step by step. Step 1. An employee asks for petty cash reimbursement or requests petty cash to pay for something. Step 2. A petty cash voucher is prepared. Step 3. The receipt is attached to the voucher. Step 4. The payment is authorized based on the rules and limits. Step 5. Cash is paid out by the petty cashier. Step 6. The voucher and receipt stay together as one complete record. This means the petty cash voucher tells the story, and the receipt proves the story is true. What a good receipt should show. A good receipt should clearly show these details. 1. The supplier name. This tells us where the item was bought. 2. The date of purchase. This shows when the expense happened. 3. The items purchased. This shows what the money was spent on. 4. The amount paid, the other costs. This shows the total cost. If any of these details are unclear, the petty cashier should ask questions before paying. What if the receipt is a small till roll and does not explain enough? Sometimes a receipt is only a small till roll. Sometimes it only shows a total amount. In that case, there is a simple good practice. The petty cashier should write a short note on the receipt or on the voucher, such as taxi fare to client meeting, stationery for office printer, emergency batteries for remote control. This makes the record clear for anyone who checks it later. Where receipts should be kept. Receipts must not be lost, so the correct method is 1. Staple the receipt to the petty cash voucher. 2. Keep it in the petty cash file or in the petty cash tin until posting is done. 3. After posting, file it safely in the accounts department. This way, every payment can be checked later. The key rule in Lesson 2.6. Here is the golden rule, students. No receipt means no proof, and no proof means the petty cashier should not pay unless a supervisor approves it. In the next lesson, we will go deeper into the details of special types of receipts. 2.61 is called sales tax receipts. Students, this lesson is about one important situation. Sometimes a petty cash payment includes sales tax. For example, VAT in the United Kingdom, or GST in Canada, or sales tax in other countries. When sales tax is included, the receipt must be a proper sales tax receipt. This is because the business may be able to claim back the tax from the government, so we need stronger evidence than a normal receipt. What is a sales tax receipt? A sales tax receipt is a receipt that proves two things at the same time. 1. The business paid money for a purchase. 2. Part of that payment was sales tax. If the receipt does not show the sales tax details, the business may not be allowed to claim the tax back. Why sales tax receipts are important? Let me explain the reason in a simple way. When a business buys something for work, the cost is an expense, but the sales tax may not always be a real final cost. If the business is registered for sales tax, it can often claim the tax back. So accountants need to separate the payment into two parts. Part 1 is the expense itself. Part 2 is the sales tax, but we can only separate it if the receipt clearly shows the tax information. That is why sales tax receipts are important. What details must be shown on a sales tax receipt? A proper sales tax receipt should show the following details. 1. The total amount paid. This is the full amount that left petty cash. 2. The sales tax paid. This is the tax part of the payment. 3. The supplier name and address. This tells us who sold the goods or services. 4. The supplier's sales tax registration number. This proves the supplier is registered for sales tax. 5. The date of the transaction. This shows when the purchase happened. If one of these details is missing, the receipt may not be accepted as a valid tax receipt. What the petty cashier should do. Now let us talk about the petty cashier's job. When someone requests petty cash reimbursement, the petty cashier should check the receipt carefully. The petty cashier should ask these questions. Does the receipt show the supplier name? Does it show the date? Does it show the total amount? Does it show the sales tax amount? Does it show the sales tax registration number? If the receipt is missing important tax details, the petty cashier should not approve it automatically. In that case, the petty cashier should refer it to a supervisor. Simple example to understand it. Imagine you buy stationery for the office. The receipt shows a total payment of $42, but it also shows sales tax of $7. This means the real stationery cost is $35, and the sales tax part is $7. So in the accounting records, we want to record an expense for the stationery and a separate amount for the sales tax. But again, we can only do that if the receipt clearly shows the tax details. The key message of lesson 2.6.1. Students, remember this rule. If sales tax is included, we must have a proper sales tax receipt. Without it, the business may lose the right to claim the tax back, and the payment may need higher approval. 2.6.2 is called No Available Receipts. Students, this lesson is very important because it happens a lot in real life. Sometimes someone spends money for the business, but they do not have a receipt. Maybe they lost it. Maybe the machine did not print it. Maybe they paid for something small and forgot to ask. So the question is, can the business still pay them back from petty cash? The answer is yes, sometimes, but only with extra control and extra approval. Because no receipt means higher risk of mistakes, higher risk of fraud, and higher risk of paying something that is not really a business expense. Why no receipt is a serious problem. Let us think like accountants. A receipt is evidence. It proves 1. The money was really spent. 2. The purchase really happened. 3. The amount is correct. 4. The expense was for business, not personal use. Without a receipt, we lose strong proof. So if we pay without a receipt, the business could be paying for something fake or personal. That is why the rules become stricter. What should happen if there is no receipt? The book explains a clear control rule. If there is no receipt, the petty cashier should not just pay automatically. Instead, the petty cashier should refer the claim to a supervisor. This means the petty cashier sends the request to a manager or an authorized person. The authorized person will decide if the payment is acceptable or not. So the petty cashier is not the final decision maker in this case. When might no receipt happen? Students, here are some common examples. A taxi ride where the driver did not give a receipt, a parking meter payment, a bus fare payment, a small traveling cost where it was difficult to get proof. These are common situations where receipts are sometimes missing. That is why the business needs a safe process. What the supervisor will check. When the supervisor receives the request, the supervisor should think carefully. They will ask questions like, was this expense necessary for the business? Was it reasonable and small? Does the employee have a good explanation? Does this type of expense happen often? Is this employee trusted and responsible? Is there any other evidence, like a written note or a log? The supervisor is trying to reduce risk before approving payment. What the petty cashier should do in practice. Now I will explain the correct classroom procedure. Step 1. The employee asks for petty cash reimbursement. Step 2. The petty cashier asks for the receipt. Step 3. If the employee has no receipt, the petty cashier does not pay immediately. Step 4. The petty cashier sends the request to a supervisor or manager. Step 5. If the supervisor approves, the petty cashier pays and records it properly. Step 6. If the supervisor refuses, the petty cashier does not pay and the request is rejected. This protects the business. How to record it when approved. Even when approved, the business must still keep some evidence on file. So the petty cashier should write a note. The note should include what the payment was for, the amount paid, the date, the name of the person being paid, the reason why there is no receipt, the name and signature of the supervisor who approved it. So even though there is no receipt, there is still a written record and authorization. Why this lesson matters in real businesses. Students, this lesson is not just theory. This is a real control method used in offices. Because petty cash is very easy to misuse. It is small money, but it is cash. And cash can disappear easily. So the business must be strict when receipts are missing. That is why lesson 2.6.2 exists. Key exam and real life point. Here is the main rule you must remember. No receipt means no automatic payment. The claim must be referred to a supervisor, and payment can only happen if the supervisor approves it. If you write this rule in your exam, you will get strong marks. This question comes right after lesson 2.6, which is about receipts and what to do when there is no receipt. So the main topic here is control and safety in petty cash. Part 1. Explaining the question. The question tells you a story. There is a person named Nick King. Nick King suggests a convenient idea. His idea is this. He wants you to leave some money, for example $30, in a kitty box at reception. Then, if employees are short of cash for small things like parking meters, phone calls, or bus fares, they can take money from the box. They can dip in and take what they need. And they do not need to bring receipts and follow the normal petty cash process. Then the question asks you to do one thing. You must explain to Nick King why this is not a good idea. So this is not a calculation question. This is a control question. It tests your understanding of safety, authorization, and evidence in petty cash. Your job is to say, no, we should not do this, and then give strong reasons. Part 2. Explaining the answer in full detail. The book's answer gives 4 main reasons. Let us go through them one by one. Reason 1. A box at reception is not physically safe. The answer says, an open box at reception is not a safe place to keep cash. It could easily get lost. It could easily be stolen. Petty cash must be protected. It must be kept in a locked petty cash box, and normally it is kept in a locked drawer or safe place. So the first problem is security. The money is not protected. Reason 2. Dipping in breaks the authorization control owls. The answer says, dipping in means the authorized person, meaning the petty cashier, is not making the payment. So we cannot ensure the payment is authorized and for a valid reason. This is a very important control point. In a proper petty cash system, the employee does not just take money. The employee requests money. Then the petty cashier checks the reason. Then the petty cashier pays the money. Then it is recorded properly. But with a kitty box idea, no one is checking the reason. No one is approving the payment. No one is controlling the cash. So the business loses control. And that creates risk, such as Someone could take money for personal spending. Someone could take money and never report it. Someone could take money and the business will not even know who took it. So the second problem is lack of authorization and lack of control. Reason 3. The amount can break the payment limit rules. The answer says, if a float of $30 is left in the kitty box, then in theory, the whole $30 could be taken and spent on one item. That would break the petty cash limit, which in this example is $25. This is about the rule called the maximum individual payment limit. Most businesses set a limit, such as no petty cash payment can be more than $25. Why do they set a limit? Because petty cash is only for small payments. Larger payments should go through normal systems like bank payment or check. Now imagine this happens. The kitty box has $30. One person takes all $30. They spend it on something. Now the business has broken its own rule. That is a control failure. So the third problem is that it can cause payments to exceed the allowed limit. Reason 4. Petty cash payments should normally have a receipt. The answer says, usually petty cash can only be paid out if there is a receipt. But the kitty box suggestion means payment can be made without a receipt. That should only happen if a manager authorizes it. This is about evidence. A receipt is proof. A receipt answers important questions like what was bought, how much it cost, when it was bought, who the supplier was, whether it was a business expense. If employees take money without receipts, you cannot prove the money was spent for the business. You cannot prove it was spent honestly. You cannot record the expense correctly. So the business could end up paying for personal items, or it could lose money with no evidence. That is why the petty cash system requires documentation, meaning vouchers and receipts. So the fourth problem is lack of evidence. Final classroom conclusion. We say this, Nick King's idea sounds convenient, but it is not safe and it is not controlled. It removes security, it removes authorization, it can break the payment limit rules, and it removes receipts, meaning there is no proof. That is why a proper petty cash system must be used instead, with a locked box, a petty cashier, authorization, and receipts. 3. The imprest system. All right, students, now we are starting lesson 3. This lesson is about something very important in petty cash. It is called the imprest system. The imprest system is the most common and the safest way to run petty cash. 1. What the imprest system means. In simple words, the imprest system means this. The petty cash box always starts with a fixed amount of money. That fixed amount is called the imprest amount. It is also called the petty cash float. So the business chooses a fixed float and it stays the same every time we refill petty cash. Example idea. At the beginning of the month, the petty cash float might be $200. That $200 is the imprest amount. 2. What happens during the month? During the month, people will request small payments from petty cash. For each petty cash payment, 2 things must happen. First, cash goes out of the petty cash box. Second, a voucher and receipt go into the petty cash box. So as time passes, the cash in the box becomes less and less, but the number of vouchers and receipts becomes more and more. This is exactly what we want, because the vouchers act like evidence. They prove where the cash went. 3. The golden rule of the imprest system. This is the most important rule of the imprest system. At any time, cash left in the petty cash box, plus vouchers and receipts for payments made, equals the imprest amount. Let me say it again slowly, because this line is the key. Cash left plus vouchers equals imprest amount. So if the imprest amount is always fixed, then we can easily check if something is wrong. 4. What topping up the imprest means. After some time, the petty cash box will have low cash, so the business must refill it. This refill is called topping up the imprest. Here is the main idea. We top up petty cash with exactly the amount that has been spent. That way, the petty cash goes back to the original imprest amount again. So after topping up, the petty cash float becomes full again. It returns to the same fixed amount as before. 5. How we know how much to top up paying. In the imprest system, we do not guess. We calculate the top-up amount like this. Total vouchers for payments made equals the amount needed to top up. So if vouchers and receipts show that $100 was spent, then we top up with $100. After that, the petty cash box goes back to the imprest amount. 6. Why the imprest system is a strong control. The imprest system is used because it is safe and easy to control. Here are the main reasons. 1. It is easy to check if cash is missing, because cash plus vouchers must always match the imprest amount. 2. It reduces fraud and reduces mistakes, because every payment must have evidence. 3. It makes petty cash organized. Nothing is paid without recording and proof. 4. It makes topping up simple, because the top-up equals the voucher's total. So the imprest system is not only a method, it is also a control system. 7. The role of the petty cashier in the imprest system. The petty cashier is responsible for keeping the system correct. The petty cashier must keep the cash safe in a locked box, pay only approved petty cash payments, collect vouchers and receipts for every payment, keep proper records, prepare the top-up request when cash is low. So in a good imprest system, the petty cashier does not just give cash. The petty cashier controls the whole process. 8. Important classroom summary. Let us summarize Lesson 3 in one clean idea. The imprest system keeps petty cash at a fixed amount. When money is spent, vouchers replace the cash. Then the cash is topped up by the exact amount spent. So the float returns to the original imprest amount again. That is Lesson 3. 3.1. Example, topping up the imprest class. In this example, we are practicing how to top up petty cash under the imprest system. Remember what imprest means. Imprest means the petty cash float stays at a fixed amount all the time. So every time the money in the petty cash tin goes down, we refill it back up to the fixed imprest amount. In this example, the fixed imprest amount is $1,000. Let's read the information step by step. 1. On the 1st of May, the imprest amount is $1,000. That means the petty cash tin starts the month with $1,000 inside it. 2. During the month of May, petty cash payments are made. The book tells us that there are 57 receipts in total. The total value of these receipts is $826.40. So during May, the petty cashier paid out $826.40. 3. At the end of the month, on the 31st of May, we check the cash left in the petty cash tin. The cash left is $173.60. This makes perfect sense because we started with $1,000. We spent $826.40. So the money left should be $173.60. Now let us calculate the top up. The top-up is the amount we must bring in from the bank to restore the float back to $1,000. Top-up amount equals imprest amount minus cash left in the tin. So we do it like this. Imprest amount, $1,000. Cash left in tin, $173.60. Top-up needed, $826.40. So the check that we draw from the bank must be for $826.40. What happens after we top up? After we take that cash from the bank and put it into the petty cash tin, the tin goes back to the original level. Cash in tin at month end, $173.60. Plus top up from bank, $826.40 equals restored imprest amount, $1,000. That is why the last line of the example says, restored imprest amount equals $1,000. What this example is teaching you, Will. This example teaches one very important idea. In the imprest system, you do not decide the top-up amount randomly. You calculate it based on the receipts and the cash left. Also notice something very important. The total receipts for the month are exactly the same as the top-up needed. Total petty cash receipts for May, $826.40. Top-up required from the bank, $826.40. This is not a coincidence. This is the whole point of imprest. It creates control and accuracy, because every dollar that left the tin must be supported by a receipt. And the total receipts tell you exactly how much money the bank must replace. What the petty cashier would physically do in real life. At the end of the month, the petty cashier will do these actions. 1. Collect and total all the receipts. In this case, the total is $826.40. 2. Count the cash left in the tin. In this case, it is $173.60. 3. Prepare a check requisition for the top-up amount. That amount is $826.40. 4. Take the check to the bank and withdraw the cash. 5. Put the withdrawn cash into the petty cash tin. Now the tin is back to $1,000, ready for the new month. 4. Petty cash vouchers. Now we are going to learn one of the most important documents in petty cash. It is called the petty cash voucher. A petty cash voucher is the main written proof that petty cash money was paid out. Without this voucher, petty cash becomes messy and unsafe, because cash can disappear very easily if there is no proper paperwork. What is a petty cash voucher? A petty cash voucher is a small form that the petty cashier completes every time petty cash is paid out. Think of it like this. The petty cash voucher is the mini invoice inside the business. It explains what the cash was used for. It also shows who received the cash, and it shows who approved the payment. So the voucher becomes the official record of the payment. Why do we need a petty cash voucher? We use petty cash for small day-to-day business payments. These payments happen often, so we need a simple system to control them. The petty cash voucher helps because it gives us 4 strong controls. 1. Proof. It proves the cash was paid for a real business reason. 2. Tracking. It helps the business track every small payment, one by one. 3. Accountability. It shows the exact person who took the cash, so nobody can deny it later. 4. Protection against mistakes and fraud. It makes it harder for someone to take cash for personal use, because every payment must have a voucher and a receipt. When is a petty cash voucher prepared? A voucher must be prepared whenever a petty cash payment is requested. So the correct timing is this. First, someone requests petty cash. Second, the petty cashier prepares the voucher. Third, the payment is made. Fourth, the receipt is attached to the voucher. Fifth, the voucher is kept safely as part of the petty cash records. This is why the book says the voucher is the initial record of the payment. Who prepares the voucher? The petty cashier prepares it. The petty cashier is the person responsible for petty cash, so it is their job to record every payment properly and to keep the vouchers and receipts organized. What must be attached to the voucher? The receipt must be attached to the voucher. This is extremely important because the receipt is the evidence that the business really bought something, and the voucher is the evidence that petty cash money was paid out. So these two documents work together. Voucher plus receipt. The receipt is normally a shop receipt, also called a till roll receipt. Sometimes it may be another type of proof, but in most cases it must be a receipt. The receipt should be stapled firmly to the voucher, so it does not get lost. What details must be written on the petty cash voucher? Now class, this part is the heart of this lesson. A voucher is only useful if it is filled in correctly. A complete petty cash voucher should contain these details. 1. Details of the payment. This means the purpose. What was the cash used for? Example, office supplies, or taxi fare, or postage stamps. The purpose must be clear. Never write something too general like miscellaneous. 2. The amount paid. This is the exact amount of cash given out. It should match the receipt. If the receipt says $82.56, the voucher must say the same. 3. The name of the person receiving the cash. This is the person who took the money. It might be an employee or it might be a supplier. 4. The signature of the person receiving the cash. This signature is proof that the person actually received the money. It protects the business from arguments later. 5. The authorizing signature. This is the signature of the person approving the payment. In many cases, this will be the petty cashier, but if the payment is above the petty cashier's limit, then a supervisor or manager must approve it. This is how the business controls spending. 6. The date of payment. This is the date the cash was given out. Dates help when you check records later. 7. The voucher number. Every voucher must have a number. This number is very important for control. It helps you file vouchers in order. It helps you confirm that none are missing. It also makes checking and auditing easier. 8. The relevant receipt attached. The receipt must be stapled to the voucher. This completes the evidence. How the voucher works in real life. Let us imagine a simple example. An employee needs petty cash to buy office stationery. The employee requests the money. The petty cashier prepares a petty cash voucher. The voucher states stationery as the purpose. The voucher states the amount. The employee signs the voucher when receiving the cash. The petty cashier signs to authorize the payment. The date is written on the voucher. The voucher is given the next number in the sequence. After the employee buys the stationery, they bring back the receipt. The petty cashier staples the receipt to the voucher. Now the voucher and receipt become one complete record. That is proper petty cash control. Why the voucher number matters so much, I want you to remember this like a classroom rule. No voucher number means weak control. A missing number can hide missing vouchers, and missing vouchers can hide missing cash. So numbering vouchers in sequence helps you in 3 ways. 1, it creates order. 2, it shows completeness. 3, it makes checking easier. Common mistakes students must avoid. Here are the most common problems that make petty cash records weak. 1, no receipt attached. This is the biggest problem. No receipt means no evidence of purchase. 2, vague description. If the purpose is unclear, the voucher becomes useless. 3, wrong amount. If the amount does not match the receipt, it creates confusion. 4, no signature of the person receiving the cash. This removes accountability. 5, no authorization. This removes control and increases the chance of misuse. 6, voucher not filed safely. If vouchers are lost, the petty cash system breaks down. Final classroom summary. A petty cash voucher is the first and most important document in recording petty cash payments. It is prepared every time petty cash is paid out. It must be completed properly. It must include full details and signatures, and the receipt must be attached and kept safely. When a business follows this rule, petty cash stays controlled, clear, and trustworthy. Class. Let us now explain the question and its answer step by step in a very clear way. The question says, you have the following receipts in the petty cash box at 30 November. By how much should the balance in the box be topped up? What the question is really testing. This is an impressed system question. That means the petty cash float is fixed. So at the end of the month, we always top up the petty cash tin back to the impressed amount. In this question, the impressed amount is $150. So our target is always to bring petty cash back to $150. The receipts given in the question, however, these are the receipts found in the petty cash box at 30 November. 1. Tea bags, $1.99. 2. Light bulbs, $5.99. 3. Train fare, $10.50. 4. Teapot and cups, $24.99. 5. Desk lamp, $19.99. 6. Stamps book, $10. Step 1. Add the receipts carefully. Now we add all the receipts because receipts show how much money was paid out. Start with the first receipt. Tea bags, $1.99. Running total is $1.99. Add light bulbs, $5.99. Running total is $7.98. Add train fare, $10.50. Running total is $18.48. Add teapot and cups, $24.99. Running total is $43.47. Add desk lamp, $19.99. Running total is $63.46. Add stamps book, $10. Final total is $73.46. So the total receipts equal $73.46. Step 2. Understand what top-up means. Top-up means how much cash we must bring in from the bank to restore petty cash back to $150. Under the impress system, the top-up amount is normally equal to the total receipts because the receipts represent the amount that left the petty cash tin. So in this question, top-up required equals total receipts. Top-up required equals $73.46. That is exactly the answer shown in the book. Step 3. Extra check to feel confident. Let us double check using logic. Impressed amount at start should be $150. Money spent during the month, according to receipts, is $73.46. So cash left in the tin must be $150 minus $73.46. Cash left equals $76.54. Now if we add the top up, cash left $76.54 plus top up $73.46 equals $150 again. Perfect. That means our answer is correct. Final answer. The petty cash box should be topped up by $73.46. 4.1 is showing you a real example of a petty cash voucher and how it is used in a company. Think of a petty cash voucher as the paper proof for every small cash payment. It answers 3 big questions for the business. 1. What was the cash used for? 2. Who received the cash? 3. Who approved the payment? Now let us walk through the example from the book, slowly, like we are doing it inside a real office. Part 1. The rules of the company in this example. Before any payment is made, the company has rules. Rule 1. There is a maximum limit for one petty cash payment. In this example, the maximum individual payment is $100. Rule 2. The petty cash cashier can approve only small payments. In this example, the petty cash cashier can approve payments up to $25. Rule 3. Bigger petty cash payments must be approved by a higher person. In this example, any payment between $25 and $100 must be authorized by the accounts supervisor, who is R. Green. These rules exist for control and safety. They stop people from taking cash without permission. They also make sure the business pays only for real business expenses. Part 2. What happens in the story? On the 18th of December, year X7, there is a petty cash claim. The claim is for an office Christmas party expense. The receipts from the supermarket add up to $82.56. Now notice something important. $82.56 is more than $25, so the petty cash cashier cannot approve it alone. It must be authorized by the accounts supervisor, R. Green. The cash will be paid to the office manager, D. Porter. So D. Porter is the person who will receive the money. Part 3. How the petty cash voucher is filled in. Now we look at the voucher itself. This voucher has a few key parts, and each part has a reason. 1. Voucher number. At the top, you see No. That is the voucher number. In this example, the voucher number is blank. The book tells us this voucher has not yet been given its sequential number. That means the number will be added later when the vouchers are organized and filed properly. 2. Date. The date is written as 1812X7. That date is important because it tells us exactly when the cash was paid out. This helps with checking, filing, and later auditing. 3. Details or purpose. The details box says office party. This is the reason for the payment. It explains what the money was for. If a voucher does not clearly explain the purpose, then the payment becomes suspicious. So this short description must be clear and honest. 4. Amount. The amount is written as $82.56. It is written in 2 parts, dollars and cents. This is important because petty cash is real physical money. If someone writes the amount wrongly, the cash balance will become wrong too. 5. Signature of the person receiving the cash. The voucher shows a signature line. It is signed by D. Porter. This signature is extremely important. It proves that D. Porter actually received the money. Without this signature, the business cannot be sure who took the cash. 6. Authorized by. The voucher also shows who approved the payment. It says authorized by R. Green. This matches the company rule. Because the payment is above $25, it needs supervisor authorization. So R. Green approves it. That makes the payment valid and properly controlled. Part 4. What happens after the voucher is prepared? Now imagine we are in the office, and we are completing the payment correctly. Step 1. The receipts are checked. The petty cash cashier looks at the supermarket receipts. The cashier confirms the receipts add up to $82.56. Step 2. The voucher is written. The cashier writes the date. The cashier writes the purpose, office party. The cashier writes the amount. Step 3. Approval is obtained. Because the amount is higher than $25, the cashier must get R. Green's approval. So R. Green signs as the authorizing officer. Step 4. The cash is paid out. The petty cash cashier gives the cash to D. Porter. Step 5. The receiver signs. D. Porter signs the voucher to confirm receipt of the cash. Step 6. Filing and keeping evidence. The receipts are attached to the petty cash voucher. Then the voucher is kept safely in the petty cash box or petty cash file. This creates a complete audit trail, meaning the business can prove everything later. Part 5. The main lesson you must learn from this example. This example is not just about filling a form. It teaches the control system behind petty cash. A petty cash voucher must always show what the cash was for, how much cash was paid, who received the cash, who authorized the cash, which date it happened, and it must have receipts attached as evidence. When all of these are present, the petty cash system becomes safe, organized, and trustworthy. And this is exactly what accountants want. Clear proof, clear approval, clear responsibility. 4.2 is about voucher numbers. This looks like a small detail, but in petty cash, it is one of the most important control tools. Because voucher numbers help the business stay organized, and they help prevent fraud and mistakes. Let us explain it like we are working in a real accounts office. What is a voucher number? A voucher number is a unique number written on each petty cash voucher. Unique means it cannot be repeated. So voucher number 1 is used only once, voucher number 2 is used only once, and it continues in order. So every petty cash payment gets its own identity number. You can think of it like this. If petty cash vouchers did not have numbers, it would be very easy to lose one. It would also be easy for someone to hide one, or to write the same payment twice. The voucher number stops these problems. How voucher numbers are normally given. The book explains that voucher numbers are usually given in sequence. Sequence means one after the other in order. So the business will number vouchers like this: 1, 2, 3, 4, 5, and so on. Sometimes the voucher numbers can go into hundreds or even thousands, depending on how many petty cash payments the business makes. Also, voucher numbers are often started again at 1 at the beginning of each new year. So each year starts fresh. That makes it easier to file vouchers by year. Why voucher numbers are used. Voucher numbers have two main purposes. Purpose 1. Tracing and filing voucher numbers allow vouchers to be traced in the accounting system and in the files. Meaning, if you see voucher number 45 in the petty cash record, you can go to the voucher file and find voucher number 45. So it becomes quick and easy to locate proof for any payment. This is very important for managers, auditors, and accountants. Purpose 2. Checking completeness. Voucher numbers help the business make sure no voucher is missing. Because if the voucher numbers go like this, 41, 42, 43, 44, 45, and suddenly you see 41, 42, 44, 45, then you know voucher number 43 is missing. That is a big warning sign. A missing voucher could mean a voucher was lost by mistake, or a payment was made, but the paperwork was not kept, or someone is trying to hide a payment. So voucher numbers help the business detect missing documents quickly. This is called a completeness check. Completeness means making sure every payment has been recorded and supported. When the voucher number should be written. The voucher number should be written either at the time the payment is made, or when the petty cash cashier is preparing vouchers for posting into the accounting system later. Different businesses have different procedures, but the key idea is always the same. Every voucher must receive a number, and numbers must be in order. What happens after the voucher is prepared and numbered? After the voucher has been completed, signed, and the cash has been paid out, the voucher must be kept safely. It stays inside the petty cash box or petty cash file until the petty cash is topped up. Then, when it is time to top up the petty cash float, all those vouchers will be used to record expenses and explain why the petty cash needs more money. So voucher numbers help the business connect three things: the cash payment, the voucher proof, and the accounting record later. Small classroom example to make it very clear. Imagine you are the petty cash cashier. You make 5 payments in 1 week. Payment 1, taxi fare. Payment 2, stamps. Payment 3, milk. Payment 4, tea and coffee. Payment 5, stationery. Now you number the vouchers. Voucher 1, taxi fare. Voucher 2, stamps. Voucher 3, milk. Voucher 4, tea and coffee. Voucher 5, stationery. Now a manager comes and asks, "Show me the voucher for the stationery." You immediately find voucher number 5. That is the power of voucher numbers: fast, clear, and controlled. Final message you must remember for exams. Voucher numbers are used to keep petty cash organized, trace vouchers easily in files, make sure no vouchers are missing, help prevent errors and fraud. That is lesson 4.2. Lesson 4.3 is about a situation that happens a lot in real offices. Sometimes the business needs to give petty cash before the expense actually happens, meaning the business is paying in advance. This lesson explains how to do that correctly and how to keep control so that money is not lost or misused. What does expenses not yet incurred mean? An expense is incurred when the business has actually used something or bought something or received a service. So expenses not yet incurred means the business has not bought the item yet, the business has not received the service yet, but the person needs cash now so they can go and pay. This is also called an advance. So you can think of it like this. The business is saying, here is the cash first, go and buy the item, then bring back the proof. Why does this happen? This happens for a simple reason. Sometimes a worker must go out and pay for something immediately. For example, taxi fare for work, a quick purchase of supplies, parking payment, a small emergency item, and the worker might not have enough personal cash on them, so they ask the petty cash cashier for money in advance. Why advance payments are risky? Now, in accounting, anytime you give cash before you get the receipt, there is a risk. The risk is the person might not bring the receipt back. The person might spend the money on something else. The person might spend more than they should. The person might forget to return the change. That is why this lesson focuses on control. The correct rules for paying petty cash in advance. Rule 1. The advance must be authorized first. The book is clear about this. Payments in advance must be authorized by a supervisor or an office manager. So the petty cash cashier should not decide alone. The cashier must get approval from someone in authority. This protects the cashier and protects the business. Rule 2. A petty cash voucher must still be written. Even though the expense has not happened yet, a voucher must still be prepared. The voucher will show who is receiving the cash, why they are receiving it, how much cash is being given, the date, the signatures. So the voucher becomes the temporary proof until the receipt arrives. Rule 3. The person must return with 2 things. After the person makes the purchase, they must return the receipt and any change that is left over. Both are important. The receipt proves the money was used for the business. The change brings unused money back into petty cash. Rule 4. The voucher must be adjusted to the final correct amount. This is very important. Sometimes the person will not spend the exact amount of cash they received. So when the receipt and change come back, the petty cash cashier must update the voucher. The voucher must end up showing the real expense amount, not just the cash given out. So in simple words, cash given minus change returned equals the real expense. That real expense is what the voucher must finally show. How it looks in real life, step by step. Let us do it slowly, like we are in a classroom. Step 1. A staff member says, I need petty cash now to pay for something for work. Step 2. The petty cash cashier asks, what is it for and how much do you need? Step 3. The cashier gets authorization from the supervisor or manager. Step 4. The cashier prepares a petty cash voucher. The voucher states the purpose clearly, like taxi fare for business travel or emergency stationery for office use. Step 5. The cashier gives the cash to the staff member. Step 6. Later, the staff member comes back with the receipt and any change. Step 7. The cashier attaches the receipt to the voucher. Step 8. If the final expense is different, the cashier adjusts the voucher so it shows the true expense amount. Step 9. Now the voucher is complete and it stays as evidence until the petty cash is topped up and posted. Why the voucher adjustment matters so much. This adjustment step is not extra work. It is a key accounting control. because the accounting records must show the correct expense. If the staff member was given $40 but only spent $35, then the expense is $35, and $5 should come back as change. If we forget to do this, petty cash will slowly lose money and no one will understand why. So the voucher adjustment keeps petty cash accurate. The main lesson to remember: when petty cash is paid in advance, we must still keep proper control. So we must always remember 4 things. Authorization first. Voucher prepared before the cash is given. Receipt and change returned later. Voucher corrected to match the real expense. That is lesson 4.3. Now we will do lesson 4.4, the example of petty cash payments for expenses not yet incurred. This example is very important because it shows a real-life situation where the business gives cash first and the receipt comes later. So let us go through it slowly, step by step, like we are in a classroom. The situation in the example A, director of the company needs money to pay for a taxi, but the taxi has not been paid yet, so the director asks for petty cash in advance. The request is for $20, 20.00. This happens on the 5th of July, year 20x7. Because this is an advance payment, it must be authorized by a supervisor. In the example, the authorization is given by the account supervisor, T. Roberts. So the company is being careful and following the control rules. Step 1. The petty cash voucher is written first. Even though the taxi has not been paid yet, the petty cash cashier must prepare a petty cash voucher. The voucher is the evidence that cash is being given out. At this moment, the cashier writes the voucher with these details. Date of payment, 5th of July, year 20x7. Details or purpose, taxi fare. Amount paid out, $20. Signature of the person receiving cash, the director. Authorized by T. Roberts, the supervisor. So at this stage, the voucher is like a promise record. It is saying, we gave out $20 for taxi fare, and we are waiting for the receipt and the final proof. Step 2. The cash is given to the director. After the voucher is written and authorized, the petty cash cashier gives the cash. So now the petty cash box is reduced by $20, and the director can go and pay the taxi. Step 3. The director returns the next day with the receipt and the change bets. On the next day, which is the 6th of July, year 20x7, the director comes back. Now we finally know what the taxi really cost. The taxi receipt shows $15.50, so the director did not use the full $20. That means there is extra money left. So the director must return the change. $20 minus $15.50 leaves $4.50. So the director gives back $4.50 in cash. This is very important because petty cash must not lose money. Any unused part must return to the box. Step 4. The voucher is adjusted to show the true expense. Now the petty cash cashier does something very important. The cashier updates the original voucher because the voucher must show the real expense amount. The real expense is not $20. The real expense is $15.50. So the cashier amends the voucher and makes sure the paperwork shows. Taxi fare expense was $15.50. Change returned was $4.50. The taxi receipt is attached to the voucher. This creates full proof and full control. Now the documents clearly show what happened. Cash was given first. The receipt came later. The change was returned. The final real expense is correct. What we learn from this example. This example teaches 3 strong lessons. Lesson 1. Advance payments must be authorized. Because giving cash before getting a receipt is risky, so a manager or supervisor must approve it. Lesson 2. A voucher must still be written before cash is paid out, even when the receipt does not exist yet. The voucher is the temporary proof. Lesson 3. The voucher must be corrected when the receipt comes back. So the accounting system records the correct expense. The accounting system must record taxi fare of $15.50, not $20, because the $4.50 came back into the petty cash box. Very important exam-style sentence. In petty cash, the final expense is always the amount shown on the receipt, and any extra cash given out must be returned as change. That is exactly what this example is teaching you. Now we will explain lesson 4.5, checks on petty cash and vouchers. This lesson is extremely important because it is about control. It is about protecting the petty cash money, and it is about making sure nothing is missing or stolen. I will explain it like a full classroom lecture, step by step, and in a read-aloud friendly way. Lesson 4.5, checks on petty cash and vouchers. In petty cash, payments happen many times each week. For example, small payments like tea, coffee, milk, bus fares, stationery, postage stamps, small repairs, small travel expenses. Because many payments happen, it is easy for mistakes to happen too. So we must do regular checks. A check means we stop and we compare the money and the paperwork. We check if everything matches correctly. What must match in petty cash? At any time, the petty cash should be equal to the impressed amount. Remember, the impressed amount is the fixed total amount allowed in the petty cash system. For example, if the impressed amount is $200, then cash in the box plus vouchers in the box must equal $200. This is the main rule. So the check is based on this rule. The petty cash check formula. The book gives a very important formula. We can say it like this: notes and coins in the petty cash box plus total value of vouchers for payments already made equals the impressed amount. So it should always balance. If it balances, everything is correct. If it does not balance, something is wrong. What are vouchers and why do they matter? A voucher is the paper record for each petty cash payment. Every time money goes out, a voucher should be written. The voucher usually has the date, the reason or purpose of payment, the amount paid, the person receiving the cash, the authorizing signature, the receipt attached if possible. So vouchers are proof. Without vouchers, petty cash becomes unsafe and untrustworthy. How the check is done in real life. Let us imagine you are the petty cash cashier. It is the end of the week. Now you must check the petty cash box. You will do it in a simple order. Step 1. Count the cash in the box. Count all notes and coins carefully. Step 2. Add up the vouchers inside the box. These vouchers represent the payments already made. Step 3. Add cash plus vouchers. Now compare your total to the impressed amount. If it matches, you are perfect. If it does not match, there is a discrepancy. What is a discrepancy? A discrepancy means the petty cash does not balance. It means cash plus vouchers is not equal to the impressed amount. So there is either too much money or too little money. Even if the difference is very small, it must be investigated. The book says clearly that all discrepancies must be investigated, because small differences can become big problems later. Why regular checks are needed? The reason regular checks are needed is security. Petty cash is easy to misuse because it is real cash. Cash is easy to take. Cash is easy to hide. So checks help stop fraud and stop careless mistakes. Also, checks help the company know that petty cash records are accurate. Possible reasons why the petty cash does not balance. The book gives 3 common reasons. Let us explain them clearly. Reason 1. A mistake in writing the voucher amount. This can happen when someone writes the wrong amount on the voucher. For example, the voucher says $10, but actually $12 was paid. Or the voucher says $20, but actually $2 was paid. So the paperwork does not match the cash movement. Reason 2. Incorrect money paid out. This happens when the petty cash cashier gives the wrong amount. For example, a person should receive $8, but the cashier gives $10. That creates a shortage later. Reason 3. Theft from petty cash. This is the most serious reason. Someone may take cash without permission. This could be an employee, a visitor, even a person who has access to the petty cash box. That is why access must be controlled. Only the petty cash cashier should handle it. What to do if the petty cash does not balance? When a discrepancy is found, the petty cash cashier must not ignore it. The correct action is report it immediately to the supervisor. Then investigate. Investigation means check vouchers again. Recount cash again. Check if any vouchers are missing. Check if any receipts are missing. Check if the cash was given to the correct person. Check if the amount was authorized correctly. If the problem is theft, then strong action will be needed. What lesson 4.5 is teaching you? This lesson is teaching one big idea. Petty cash is small, but it is still part of business money, so it must be controlled and checked regularly. The business must always be able to say, every petty cash payment is proved by a voucher. Every voucher is supported by a receipt when possible. Every payment is authorized, and the petty cash box always balances to the impressed amount. Mini classroom summary. Let us summarize lesson 4.5 in one clear summary. Petty cash checks are regular comparisons between cash and vouchers. Cash plus vouchers must equal the impressed amount. If there is any difference, it must be investigated. Differences usually happen because of mistakes, wrong amounts, or theft. If you are ready, next lesson is 4.6, which is about IOUs and petty cash. 4.6. IOUs and petty cash class. Now we are learning a very important warning lesson. This lesson is about something that can destroy the control of petty cash if the business allows it. It is called an IOU. An IOU means I owe you. It is a small note that someone writes when they take cash, promising to pay it back later. So in simple words, an IOU is like a temporary personal loan from the petty cash box. Now let us understand this lesson very clearly. What an IOU looks like in real life. Imagine an employee opens the petty cash box and says, I will take $10 now and I will return it tomorrow. Then they leave a paper in the box saying, I owe you $10, signed. This is an IOU situation. The cash is gone from the box, but there is no receipt. There is no business expense. There is no proper voucher. There is only a promise. That is why this is dangerous. Why IOUs are not allowed in petty cash. In proper accounting control, petty cash is not for lending money. Petty cash is for paying small business expenses. So the first problem is purpose. An IOU is not an expense. It is not a business purchase. It is not a business payment. It is just borrowing. So it is not a valid use of petty cash. The second problem, no evidence of a real business expense. Every petty cash payment should be supported by a petty cash voucher and normally a receipt, but an IOU does not prove any purchase happened. It only says someone took money. So if an auditor checks the petty cash box, they will ask, what was this cash spent on? If the answer is only IOU, that is not acceptable evidence because there is no proof of business spending. The third problem, it breaks the impressed system control. Remember the impressed rule. Cash in the box plus vouchers for payments made equals the impressed amount. Now look at what happens with an IOU. Cash is removed, but there is no proper voucher for an expense, so the petty cash will not balance correctly. Yes, there may be a piece of paper in the box, but that paper is not a real petty cash voucher. It is not proof of a real expense. It is not proof of authorization. So impressed control becomes weak. The fourth problem, IOUs can lead to theft and fraud. This is the biggest danger. If a business allows IOUs, people will start using petty cash like a personal wallet. Someone may borrow today, then borrow again next week, then borrow again next month. Some people may forget to repay, some people may refuse to repay, some people may repay late, and some people may misuse it intentionally. So IOUs create a system where petty cash can slowly disappear. This is why accountants do not like IOUs. The fifth problem, it becomes unfair and creates arguments. If one person is allowed to borrow from petty cash, other people will also ask. Then the petty cashier will face problems like, who is allowed to borrow, how much they can borrow, when they should repay, what happens if they do not repay. It becomes messy and unprofessional, so the business should avoid this situation completely. What should be done instead of using an IOU? Now class, this part is very important. Sometimes people ask for an IOU because they need cash for a business reason, but the expense has not happened yet. In that case, the correct method is not an IOU. The correct method is a proper petty cash advance for business purposes. This means a voucher is written first. The payment is authorized by a supervisor. The person receives cash and signs. Then they return with the receipt and any change. The voucher is updated to show the real final expense, so there is control. An IOU is a personal promise. A petty cash advance is an official business process. They are not the same. Very simple comparison for students. Let us make it extremely clear. Allowed situation. Advance for business expense. Example, cash needed to buy for the office. Control, voucher, plus authorization plus receipt later. Not allowed situation IOU for borrowing money. Example, employee needs money for personal reasons. Control, only a promise, no receipt, no business proof. So the rule is, no personal borrowing from petty cash. What the petty cashier should do if someone asks for an IOU. If someone asks the petty cashier, can I borrow money and leave an IOU, the petty cashier should do this. First, politely refuse. Second, explain that petty cash is only for business expenses. Third, if the request is for a business purpose, ask for supervisor authorization and prepare a proper voucher. This protects the petty cashier. It also protects the business. Exam point you must remember. If you see a question in the exam that mentions IOUs in petty cash, you must write the main reasons clearly. An IOU is not evidence of an expense. It breaks petty cash control. It creates risk of fraud and theft. It should not be allowed in a properly controlled petty cash system. That's lesson 4.6. 4.7. Receiving money into petty cash. All right, students. Now we are learning something that many beginners forget. Petty cash is not only about paying money out. Sometimes money also comes back into the petty cash box. This lesson explains what it means to receive money into petty cash, why it happens, and how we record it safely. This lesson is about control. Because whenever cash moves, we must have proof and records. What does receiving money into petty cash mean? Receiving money into petty cash means cash is being put into the petty cash box. So instead of money leaving the box, money is entering the box. This can happen for several reasons, such as a top-up from the bank, change returned after an advance, a refund from a supplier, money received from staff for a small office item. So remember this sentence. Receiving money into petty cash means increasing the cash inside the petty cash box. Why is this lesson important? This lesson is important because cash can cause confusion. If money is received and not recorded properly, the petty cash will not balance. Then the imprest system becomes unreliable. Also, if money comes in and there is no record, it can create problems like missing evidence, incorrect cash balance, arguments about where the money came from, weak internal control. So the rule is simple. Any money received into petty cash must be recorded properly and supported by evidence. The most common reasons money is received into petty cash. Now let's go through the main situations one by one. 1. Topping up the imprest amount. This is the most common reason. In the imprest system, the petty cash float is fixed. For example, $150. During the month, petty cash is spent, so cash in the box becomes lower. At the end of the period, the business tops up petty cash. The money comes from the bank or main cash. So the petty cashier receives cash into petty cash. This top-up amount is normally equal to the total vouchers for the period. So that is the first reason. Top-up money is received to restore the float back to the imprest amount. 2. Change returned after paying money in advance. This happens when someone is given money first, before the expense happens. For example, an employee is given $20 to pay for a taxi. Later, the taxi receipt shows the taxi cost was $15.50, so the employee must return the extra cash. That extra cash is called change. That change is money received back into petty cash. So the petty cash box increases again. This is a very important control point. If the change is not returned, petty cash will become short. So the second reason is change returned after an advance payment. 3. Refunds from suppliers. Sometimes the business pays for something, but later receives money back. For example, the business buys an item, then it is returned because it is faulty. The shop gives a cash refund, or the business accidentally paid too much. The supplier returns the extra amount. If the original payment was made from petty cash, then the refund should go back into petty cash. So this becomes money received into petty cash. 4. Money received from employees for personal items. Sometimes this can happen in offices. For example, the business might buy tea, coffee, or sugar for staff. Sometimes employees contribute money for personal use. If the office allows this, the money given by employees is received into petty cash, but this must be controlled carefully because petty cash is for business. So if money is received from employees, it must be recorded clearly with a reason. The petty cashier must not accept cash without explanation. How should money received into petty cash be recorded? Now, students, this is the key part of the lesson. Whenever money comes into petty cash, we must do two things. 1. Put the cash into the petty cash box immediately. 2. Record it properly with evidence. So the petty cashier must create a clear record, such as a petty cash receipt voucher, or a note on the petty cash sheet showing money received. The record must show the date, the amount received, the reason for receiving the money, the name of the person who gave the cash, a signature if needed. This is very similar to the idea of a voucher for payments, but here it is the opposite direction. Instead of cash going out, cash is coming in. Why we need evidence even when money is coming in? Some students ask, "Teacher, why do we need proof if the business is receiving money?" That sounds like a good thing. But in accounting, we need proof for all cash movements. Because without proof, someone could do something like this. They take cash out secretly. Then later they put a small amount back, and they claim it was a receipt. Or someone could put cash into petty cash that does not belong to the business. Then later take the same cash out. So the rule is, receiving money must be controlled exactly like paying money. Cash must never move with no record. How this connects to the imprest system? Check. Remember the imprest rule. Cash in the box plus vouchers equals imprest amount. Now, when money is received into petty cash, it affects the cash balance. If we record it properly, the imprest check will still work perfectly. For example, if an employee returns change of $4.50, the cash balance increases by $4.50. If we do not record it, then later the petty cash will look too high and people will get confused. So receiving money must be recorded so that petty cash stays accurate and balanced. A simple classroom example. Let us do a clear example. A staff member is given $30 as an advance to buy office supplies. Later, they return with a receipt of $26. They must return change of $4. Now the petty cashier must do this. Step 1. Receive the $4 back. Step 2. Put the $4 into the petty cash box. Step 3. Attach the receipt to the voucher. Step 4. Write on the voucher that $4 change was returned. Step 5. Make sure the final expense is recorded as $26, not $30. This is correct control. Who should receive money into petty cash? Only the petty cashier should receive money into petty cash. This is a security rule. If many people receive cash and place it into the box, the control becomes weak. So the correct process is, cash is handed to the petty cashier. The petty cashier counts it immediately. The petty cashier records it immediately. Then the petty cashier stores it safely. Final summary of Lesson 4.7. Let us summarize this lesson in a simple way. Receiving money into petty cash means cash is put into the petty cash box. It happens for reasons like top-ups, change returned, and refunds. Every receipt of cash must be recorded properly with evidence. Only the petty cashier should handle this cash. This keeps petty cash safe, accurate, and balanced under the imprest system. Now let us do the question and answer that comes right after Lesson 4.7 on page 198. This question is testing one very important skill. It is testing whether you can look at a payment request and decide, 1, is it a real business expense? 2, can it be paid from petty cash? 3, and most importantly here, can the petty cashier authorize it right now, or must it go to a manager? Part 1. What the question is asking you to do. The question says, on Tuesday, 15th December, 20x7, you receive 4 different requests for reimbursement. Reimbursement means someone paid or wants money back, and they are asking petty cash to pay them. Then the question gives 4 cases, letter A to letter D. and it asks one clear task. For which of these items would you be able to provide authorization? Authorization means approval. It means you have the right to say, yes, pay this from petty cash. And at the bottom, it gives choices. Option 1, A and C only. Option 2, B and D only. Option 3, C and D only. Option 4, none. So your job is to check each request one by one and decide, can I approve it right now under petty cash rules or not? Part 2. The rules you must remember before answering. To answer correctly, you must use the petty cash control rules from this chapter. Rule 1. Petty cash is for small business payments. It is not for personal spending. Rule 2. Every petty cash payment must be supported by evidence. Usually this means a receipt. If there is no receipt, the payment becomes risky. It may need a manager's decision. Rule 3. There is a maximum limit for a petty cash payment. In this chapter's scenario, any single petty cash payment above $25 is too large, so it should be paid from the main bank account, not from petty cash. Rule 4. The petty cashier has an authorization limit. That means the petty cashier can approve small payments only, up to $10. Anything above $10 must be approved by the administration manager. Now we apply these rules to each request. Part 3. Now let us explain the answer, step by step. The book's answer says the correct choice is none. That means not even one of the 4 requests can be authorized by the petty cashier in this situation. Let us prove it carefully. A. Bus tickets for the new office clerk, total $3.60. This looks small, so students may think, yes, petty cash can pay it. But we must ask the most important question first. Is this a business expense? These bus tickets are for the clerk's travel to work. That means it is the employee's normal commuting cost. Commuting to work is a personal cost. It is not an expense of the business. So even though it is a small amount, it is not allowed as a business petty cash payment. That is why the answer says the cost of an employee's daily travel to work is not an expense of the business. So item A is refused. B. 10 printer cartridges, $5.50 each, invoice sent with the goods. Now let us calculate the total cost. 10 cartridges times $5.50 each equals $55. So the total is $55. Now check the petty cash limit rule. Petty cash maximum is $25 per individual payment. $55 is bigger than $25. So this payment is too large for petty cash. It should be paid through the main bank account using the normal payment system. That is why the answer says this request exceeds the $25 limit applying to petty cash disbursements. The bill will be paid from the main bank account. So item B is refused. C. The caretaker asks for $5 as a gratuity to the refuse collectors. A gratuity means a tip. The amount is only $5, so the amount is not the problem. Now we check the evidence rule. Do we have a receipt for this payment? No. A tip usually has no receipt. And when there is no receipt, the petty cashier should not approve it alone because it can easily be abused. Also, tipping is sensitive. Even if it is customary, the business still needs clear approval from management. So the correct action is refer it to the administration manager for approval. That is why the answer says no receipt will be available, and the request should therefore be referred to the administration manager. So item C is refused by the petty cashier. D. Coffee, tea, and sugar for the office kitchen. Receipt total $15.40. This one is interesting, so please focus. This looks like a real business expense. It is for the office kitchen, and it has a receipt. Also, $15.40 is less than $25. So this payment could be paid out of petty cash. But the question is not asking, can petty cash pay it? The question is asking, can you authorize it? Now we check the petty cashier authorization limit. The petty cashier can only approve payments up to $10. This payment is $15.40. That is more than $10, so the petty cashier cannot authorize it. It must be approved by the administration manager. That is why the answer says the sum exceeds the $10 authorization limit and should be referred to the administration manager. So item D is also refused by the petty cashier. Final conclusion. Why the correct option is none. Now, let us summarize in one clear line for each item. A is not allowed because it is personal travel, not a business expense. B is not allowed because it is too large for petty cash. It is $55. C is not allowed because there is no receipt, so it must go to the administration manager. D is not allowed by the petty cashier because it is above $10, so it must go to the administration manager. So the petty cashier cannot authorize any of them. That is why the correct answer is none. Mini classroom takeaway to remember. Whenever you face a petty cash question in an exam, always check in this order. 1. Is it a business expense? 2. Is it within the petty cash maximum limit? 3. Is there a receipt or proper evidence? 4. Is it within the petty cashier's authorization limit? If any one of these fails, you do not authorize it, you refer it. Students, now we are starting Lesson 5. Lesson 5 is called Recording and Analyzing Petty Cash Transactions. In this lesson, the book is teaching you something very important. It is teaching you that petty cash is not just a box of notes and coins. Petty cash is also a set of accounting records. So every time money goes into petty cash or money comes out of petty cash, we must record it properly. If we do not record it, then the business will lose control, and petty cash can become messy very quickly. So Lesson 5 is about control, organization, and correct recording. What does recording and analyzing mean here? Let us break these two words into simple meaning. Recording means writing down every petty cash transaction in a proper way. So later, if someone asks, where did the petty cash go? You can answer clearly. Analyzing means organizing the petty cash payments into proper expense categories. For example, stationery expense, travel expense, postage expense, cleaning materials, and so on. When you analyze petty cash payments, you are not only writing the payment down, you're also putting it into the correct account. That is how petty cash becomes part of the accounting system. What is a petty cash transaction? A petty cash transaction is any movement of money that involves petty cash. There are only two main types of movements. Type 1. Money goes into petty cash. This happens when the business gives cash to the petty cashier. Usually, the cash comes from the main bank account. So the business takes money from the bank and puts it into petty cash. Type 2. Money goes out of petty cash. This happens when the petty cashier pays for a small business expense. For example, bus ticket for business travel, tea, coffee, and sugar for office kitchen, emergency stationery, small cleaning materials, small parking fee when allowed. So in simple words, petty cash transactions are cash in and cash out. Where does petty cash usually come from? Lesson 5 explains that petty cash is usually created from the business bank account. So the main bank account is the source of petty cash. Here is the idea. The business withdraws cash from the bank. Then the cash is placed into the petty cash tin or petty cash box. This cash is called a float. The float is the starting amount of petty cash, and that float is then used to pay small expenses during the week or month. So petty cash is not extra money. It is business money that has been moved from the bank into a cash box for small payments. Why we must record petty cash carefully. Now let me explain like a teacher in a classroom. If you do not record petty cash properly, 4 problems happen. Problem 1. You cannot prove what the cash was used for. If someone asks, why is the cash missing? You have no proof. Problem 2. The business may pay the same expense twice. One person may get money from petty cash and later also claim it again. Problem 3. It becomes easy for fraud to happen. Fraud means dishonest use of money. Petty cash is small amounts, but small amounts can add up. Problem 4. The accounts will be wrong. Remember, accounting is about correct records. If petty cash payments are not entered into the system, expenses will be too low, and cash will look higher than it truly is. So careful recording protects the business, it protects the petty cashier, and it keeps the accounting records correct. What documents support petty cash payments? Lesson 5 also reminds us that petty cash recording is not based on guessing. It is based on evidence. That evidence is usually a petty cash voucher and the supporting receipt. The voucher explains what was paid for, how much was paid, who received the cash, who authorized the payment, and the date. The receipt proves that the purchase actually happened. So we can say it like this: voucher is the internal document. Receipt is the external proof. Both are important. How petty cash becomes part of the accounting system. This is a key idea in Lesson 5. Even though petty cash is physical notes and coins, we still treat it like any other business transaction. So we record it into the accounting system. This means petty cash affects accounts such as petty cash account, bank account, and different expense accounts. So petty cash is not separate from accounting. It is connected to the general ledger. That is why Lesson 5 uses the words recording in the accounting system. Why the book says record and analyze. The book is preparing you for the next lessons where you will learn the full process, because recording alone is not enough. We also need analysis. Analysis means we separate each payment into the correct expense heading. For example, if the petty cashier pays for stationery, we do not just write paid cash, we write stationery expense. If the petty cashier pays for travel on business, we write travel expense. This is how we know what the business is spending money on. And this is how managers control spending. So analysis helps decision-making. Recording helps correctness. Both are needed. A very important classroom point to remember: petty cash transactions should not sit in the tin for weeks without being recorded. They should be recorded regularly. This keeps everything up to date, and it keeps the float easy to check and balance. So, Lesson 5 is basically teaching you this message. Petty cash must be organized, supported by documents, and entered into the accounting system properly. Quick preview of what comes next, without explaining it yet. Lesson 5 is the introduction. After this, the book goes into 2 detailed parts. Lesson 5.1 will focus on recording receipts of money into petty cash, meaning when cash enters the petty cash box. Lesson 5.2 will focus on recording petty cash payments, meaning when petty cash pays out for expenses. We will do those step by step in the next lessons. For now, make sure you understand the big picture of Lesson 5. Petty cash must be recorded, petty cash must be analyzed, and petty cash must be supported by vouchers and receipts. If you're ready, we can go to Lesson 5.1 next. Students, now we are doing Lesson 5.1. Lesson 5.1 is called Recording Receipts of Money into Petty Cash. This lesson is short in the book, but it is very important because it explains how petty cash begins and how petty cash is refilled, and it teaches you the correct accounting entry for putting money into petty cash. First, what does receipt of money into petty cash mean? In simple words, it means this. Money is moving into the petty cash box. So petty cash is receiving cash. This is not a sale. This is not income. This is simply the business taking cash from somewhere, usually the bank, and placing it into petty cash. So the petty cash box becomes stronger, and the bank account becomes smaller. That is the key idea. Where does this money usually come from? In most businesses, petty cash is filled from the bank account. So the company goes to the bank or uses a cash withdrawal and takes out cash. Then the accounts team gives that cash to the petty cashier. The petty cashier puts it in the petty cash tin or petty cash box. So the cash is still the company's money. It just moved location. It moved from the bank account into the petty cash box. What must the accounts assistant record? The book tells us that when cash is put into petty cash, the accounts assistant records it in 2 places. Number 1, in the bank general ledger account. Number 2, in the petty cash general ledger account. This is done so the accounting records stay complete and correct, because one account is going down and the other account is going up. Think like an accountant for a moment. Let us say this slowly. When we put cash into petty cash increases, bank decreases. So in accounting language, petty cash is debited, bank is credited. That is the correct double entry. If you remember only one thing from this lesson, remember this. Money going into petty cash means a debit to petty cash and a credit to bank. Step-by-step classroom explanation of the entry choices. Let us imagine a simple example. The business withdraws cash from the bank to create petty cash. Step 1. The business takes cash out of the bank account. Step 2, that cash is placed into the petty cash box. Now we record it. We record it like this: debit, petty cash, credit, bank. This entry shows the movement clearly. It shows that the bank balance went down. It shows that petty cash went up, and it keeps the accounts balanced. Why we record this movement? Now let me explain why we must record this, like a teacher in a classroom. If we do not record the cash going into petty cash, then the records will be wrong. The bank account will still look too high, and petty cash will look too low. Then later, when we try to check the petty cash balance, it will not match, and the business will become confused. So recording the receipt of money into petty cash is the first step in controlling petty cash properly. What is the real purpose of Lesson 5.1? Lesson 5.1 is teaching you one key habit. Always record when money enters petty cash. Do not wait. Do not assume you will remember later, because petty cash is used for many small payments. If you delay recording, the small payments will quickly become difficult to track. So this lesson is about discipline. It is about making sure petty cash is treated like a real accounting system, not like loose cash. Very important reminder for beginners. Many new accounting students make one mistake here. They think that money into petty cash is income. It is not income. It is not sales. It is just moving money inside the business. So the business did not become richer. The business only changed where the cash is kept. Bank became lower. Petty cash became higher. That is all. Summary of Lesson 5.1. Let's finish with a clean summary. Lesson 5.1 teaches us that 1. Petty cash is usually filled from the bank account. 2. The accounts assistant must record the cash going into petty cash. 3. The double entry is debit petty cash, credit bank. That is the complete meaning of Lesson 5.1. If you're ready, the next lesson is Lesson 5.2. That lesson explains how we record petty cash payments, meaning money going out of petty cash. Students, now we are studying Lesson 5.2. Lesson 5.2 is called Recording Petty Cash Payments. This lesson explains what we do after petty cash has been used to pay small expenses. It tells us how to record those small payments properly in the accounting system. And it explains how we use the petty cash vouchers as the proof for recording. First, what is a petty cash payment? A petty cash payment is a small payment made using notes and coins from the petty cash box. For example, it can be for small office items, small travel costs, or small emergency supplies. So the money is leaving the petty cash box. That means petty cash is decreasing. What document proves the petty cash payment? Every petty cash payment must be supported by a petty cash voucher, and usually a receipt is attached to that voucher. So the voucher and the receipt are the evidence. They answer these questions. What did we pay for? How much did we pay? When did we pay? Who received the cash? Who authorized the payment? Without the voucher, we should not record a petty cash payment because we do not have proper proof. Where are the vouchers kept before recording? After the petty cashier pays someone, the voucher is completed and kept inside the petty cash box. So the petty cash box will contain two things: cash, meaning notes and coins; vouchers, meaning the record of payments already made. That is very important because the vouchers are like paper money evidence. The cash shows what is still inside the box. The vouchers show what has already been spent. When do we record petty cash payments in the accounting system? In real life, we do not always record petty cash payments one by one immediately. Instead, we usually record them in groups. The book calls this a batch of vouchers. This batch might be recorded daily in a busy business, weekly in a normal business, monthly in a small business. So the petty cashier collects many vouchers. Then the accounts assistant enters them into the accounting system together. What is the main job in Lesson 5.2? The job is very simple to say, but it must be done carefully. We take the information from each petty cash voucher, then we record it into the accounting system. We do it voucher by voucher, payment by payment, transaction by transaction. The important rule about voucher numbering. This lesson also teaches a very important control rule. The vouchers are normally given sequential numbers. That means the voucher numbers go in order. For example, 963, then 964, then 965, and it continues. Why do we number vouchers in order? Because it helps us check that no voucher is missing. If voucher 966 is missing, we notice it immediately, and we can investigate what happened. So numbering vouchers is a control tool. It protects the business. The correct order for numbering vouchers. Here is the key detail from the book. The vouchers must first be sorted into date order. Then they are given their sequential voucher numbers. This is done so the vouchers match the real order of payments. So the flow is like this. Step 1. Collect the vouchers from the petty cash box. Step 2. Sort the vouchers by date from the earliest to the latest. Step 3. Give them the next sequential voucher numbers. Step 4. Enter them into the accounting system. This creates a clean system. It also makes checking and filing much easier. How the recording is done transaction by transaction. Now let us do this like a classroom lesson. Imagine you have 5 petty cash vouchers in front of you. We record them one at a time. Voucher number 1. You look at the voucher date. You read what the payment was for. You see the amount paid. You choose the correct expense account. Then you enter it into the system. Voucher number 2. You do the same steps again. Date, reason, amount, correct account. Enter it. And you continue like this until the last voucher in the batch is recorded. That is why this lesson is called Recording Petty Cash Payments, because we record each payment carefully and clearly. What accounts are affected when petty cash is paid? Now I want you to think like an accountant. When we pay from petty cash, 2 things happen. An expense increases because we bought something. Petty cash decreases because cash left the box. So the accounting effect is debit an expense account, credit petty cash. That is the big idea. You can imagine this example. If petty cash paid for stationery, then stationery expense increases. So we debit stationery and we credit petty cash because petty cash is going down. If petty cash paid for travel, then travel expense increases. So we debit travel and we credit petty cash again. So petty cash is always the account that decreases when we make a petty cash payment. Why recording petty cash payments is important. Let me explain why this lesson matters. If you do not record petty cash payments, the accounts will be wrong. Expenses will look too low, and petty cash will look too high. Also, the business will lose control because petty cash can disappear easily if it is not properly recorded. That is why voucher records and regular posting are important controls. A simple checklist you should remember. Whenever you are recording petty cash payments, do this. Check the voucher is properly completed. Check there is a receipt attached when possible. Check the payment is authorized. Sort vouchers by date. Number the vouchers in sequence. Record them into the system one by one. File the vouchers safely after recording. If you follow that routine, your petty cash records will always be clean and professional. Quick final summary of Lesson 5.2. Lesson 5.2 teaches us that petty cash payments are recorded using petty cash vouchers. The vouchers are collected in the petty cash box. They are recorded in batches in the accounting system. They should be sorted by date first. Then they should be numbered in sequence. Each payment is then entered transaction by transaction. That is the complete meaning of Lesson 5.2. Students, now we are on Lesson 6. Lesson 6 is called Recording Petty Cash Transactions Sales Tax. In this lesson, we are learning one important idea. Sometimes, when we pay from petty cash, the receipt includes sales tax. And when sales tax is included, we must record it correctly. We do not just record one single expense amount. We may need to split the payment into 2 parts. Part 1 is the real cost of the item before tax. Part 2 is the sales tax amount. This is a very important skill in accounting. Because sales tax is not always a real expense for the business. In many countries, the business can claim the sales tax back from the tax authority. So we must keep the records clean and correct. What is the key rule in Lesson 6? The key rule is this. If we are recording the sales tax element separately, then we must have a proper sales tax receipt as evidence. So let me say it slowly, like a teacher in class. If you want to separate sales tax in your records, you must have the correct receipt. No correct receipt means no separating the tax and no tax claim. This rule protects the business. It also protects the accountant because it stops people from claiming tax incorrectly. Why we do not ignore sales tax. In some petty cash systems, businesses ignore sales tax in petty cash payments. They do this because petty cash payments are usually small, and they think it is not worth the effort. But the book tells us the correct way. Strictly speaking, sales tax should be accounted for separately, meaning we should show it as sales tax, not hide it inside expenses. This is the proper accounting approach because it makes financial records more accurate and it helps the business recover sales tax where it is allowed. When do we record sales tax separately? We record sales tax separately only when the receipt proves the tax amount, so we must look at the receipt carefully. We ask, is this a sales tax receipt or just a simple till slip with no tax details? If it is a proper sales tax receipt, then we can record the tax separately. If it is not, then we record the full amount as an expense. What a proper sales tax receipt must show. Lesson 6 explains what details must be on a sales tax receipt. A sales tax receipt should show the total payment amount, the sales tax paid, the supplier's name, the supplier's address, the supplier's sales tax registration number, the date of the transaction. These details matter a lot, especially the sales tax registration number, because that proves the supplier is registered and it proves the tax is real and valid. How sales tax affects the petty cash recording. Now let us think like accountants. If a petty cash payment includes sales tax, we have two parts: the cost of the item before sales tax, the sales tax amount. Together, these two parts make the total paid from petty cash. So our recording becomes a split. We will record one expense amount, one sales tax amount, one total cash payment. This makes our accounting system clear, and it makes tax reporting easier. The correct accounting idea behind it. Let us understand the logic. When a business pays sales tax on purchases, that tax may be recoverable, so it is often treated like an asset, not an expense. It is like saying, we paid this tax now, but we will claim it back later. So instead of increasing expenses by the full total, we split it. We keep the expense amount clean, and we show sales tax separately. What happens if the receipt does not show sales tax properly? This is where many students get confused, so I want you to remember this simple rule. If the receipt does not qualify as a sales tax receipt, then we do not record any sales tax separately. We record the entire payment as the expense amount. Why do we do that? Because without proper evidence, we cannot support a sales tax claim. So it is safer and more correct to treat it all as expense. The classroom procedure you should follow every time. Whenever you see a petty cash receipt, do these steps. Step 1, check the receipt carefully. Step 2, ask, does it show sales tax details clearly? Step 3, if yes, split the payment into expense and sales tax. Step 4, record both parts properly in the accounting system. Step 5, if no, record the full amount as expense only. This is exactly what Lesson 6 is training you to do. It is not just theory, it is the real routine used in offices. A short final summary of Lesson 6. Lesson 6 teaches us that sales tax and petty cash payments should be recorded separately in the correct way, but we only record sales tax separately when we have a proper sales tax receipt. A proper sales tax receipt must show key details, including sales tax paid and the supplier's tax registration number. If the receipt does not support sales tax properly, we record the whole payment as an expense. That is Lesson 6. When you're ready, next we will do Lesson 6.1. Lesson 6.1 is the example where we actually calculate the sales tax amount and the net amount. Lesson 6.1 is an example that teaches you how to deal with petty cash receipts that include sales tax. In real life, when you buy small items using petty cash, the price you pay often includes sales tax. If your business is allowed to claim that sales tax back from the tax authority, then you must record the sales tax separately in your accounting records. So this example gives us two receipts, and we must answer one main question. How should these petty cash payments be recorded in the petty cash voucher and then in the petty cash general ledger account? Now let us walk through the example slowly, like we are in a classroom. Part 1. Receipt number 1. XYZ shop in Kingston. The first receipt is from a supplier called XYZ. The receipt shows the sales tax clearly and separately. It shows three important numbers. 1. The cost of the goods before sales tax. That is electric plugs and fuses. Amount is $21.54. 2. The sales tax at the rate of 20%. Amount is $4.31. 3. The total paid from petty cash. Amount is $25.85. So in this first receipt, we do not need to calculate anything because the receipt already split the total into net cost, then sales tax, then total. What we do in the accounting records is also split it the same way. How we record it in the petty cash voucher. When the petty cashier prepares the petty cash voucher, the voucher should show what was bought. Electric plugs and fuses. The net amount, $21.54. The sales tax amount, $4.31. The total paid out of petty cash, $25.85. This is very important because later, when accounts are posted, the sales tax part can be claimed back. How we record it in the petty cash general ledger. In the ledger, we treat this payment as two separate costs inside one payment. 1. Expense part. Debit the relevant expense account with $21.54. 2. Sales tax part. Debit the sales tax account with $4.31. And the total comes out of petty cash. Credit petty cash with $25.85. So the main idea is simple. Expense plus sales tax equals total cash paid. Part 2. Receipt number 2. ABC shop in Richmond. Now we go to the second receipt, which is the more important learning part. This receipt is from a supplier called ABC. The receipt says, paid $42.30 for stationery, and it says the price is inclusive of sales tax at 20%, meaning the receipt does not show the tax separately. So here the problem is, we paid one total amount, but we must split it into net cost before sales tax amount. This is exactly the situation you will face in many real businesses. The key idea you must remember: if sales tax is 20%, then the total price is not net plus 20. Instead, the total price is 100% of the net plus 20% of the net. So total equals 120% of net. That is why we use 120 in the calculation. Now let us calculate it step by step. Total paid is $42.30. Sales tax rate is 20%. Step 1. Find the sales tax amount inside the total. Sales tax amount equals 20 divided by 120 times the total payment. So we do 20 over 120 times $42.30. That gives sales tax of $7.05. So the sales tax included in this receipt is $7.05. Step 2. Find the net cost before sales tax. There are two easy ways. Way 1. Subtract the tax from the total. Total is $42.30. Minus tax is $7.05. Net becomes $35.25. Way 2. Use the net fraction. Net equals 100 divided by 120 times total. So 100 over 120 times $42.30. This also gives $35.25. So the stationery cost before tax is $35.25. Now we have the correct split. Net stationery expense is $35.25. Sales tax is $7.05. Total paid is $42.30. How we record it in the petty cash voucher. Let us now in the remaining part of the example on page 201. On this page, the book is showing you two things. 1. How the two petty cash vouchers are written. 2. How those two vouchers are posted into the ledger accounts. We will go voucher by voucher, slowly, like a classroom. Part 1. Petty cash voucher number 371. This voucher belongs to the first receipt, the one for electric plugs and fuses. On the voucher you can see voucher number is 371. Date is 20 April. Item is plugs and fuses. Net cost is $21.54. Sales tax is $4.31. Total paid from petty cash is $25.85. It is signed by the person receiving the cash, and it is authorized by the correct person. What this voucher is proving is simple. It is proving that petty cash paid out a total of $25.85. And it is also proving that inside this total there is an expense part and a tax part. So voucher 371 has two parts. Part A, expense part, $21.54. Part B, sales tax part, $4.31. And together they make the total payment, $21.54 plus $4.31 equals $25.85. Part 2. Petty cash voucher number 372. This voucher belongs to the second receipt, the one for stationery that was inclusive of sales tax. On the voucher you can see, voucher number is 372. Date is 22 April. Item is stationery. Net cost is $35.25. Sales tax is $7.05. Total paid from petty cash is $42.30. It is signed and authorized properly. Again, the voucher shows one payment, but it splits it into two parts. Voucher 372 has Part A, stationery expense, $35.25. Part B, sales tax, $7.05, and together they make the total payment, $35.25, plus $7.05 equals $42.30. So now we have our evidence documents ready. Now we move to posting into the ledger. Part 3. Posting these vouchers to the ledger accounts. On page 201, the book shows 4 ledger accounts. 1. The petty cash account. 2. The sundry expense account. 3. The stationery expense account. 4. The sales tax account. Now let us post them one at a time. Posting voucher 371. Step 1. Post the total payment into the petty cash account. Because petty cash is paying money out, petty cash is going down. So we credit petty cash with the full total. Credit petty cash with $25.85, and we write a reference like sundry expense voucher 371. This is why the voucher number is so important. It creates a clear audit trail. Step 2. Post the net expense into the correct expense account. The net expense here is the cost of plugs and fuses. The book records it into sundry expense. So we debit sundry expense with $21.54, and we write a reference like petty cash voucher 371. Step 3. Post the sales tax into the sales tax account. So we debit sales tax with $4.31. And again we reference voucher 371. So voucher 371 creates these postings. Debit sundry expense, $21.54. Debit sales tax, $4.31. Credit petty cash, $25.85. That is the full posting for voucher 371. Posting voucher 372. Now we do the same steps for voucher 372. Step 1. Post the total payment into the petty cash account. Petty cash paid out $42.30. So petty cash goes down again. Credit petty cash with $42.30. And we reference it to stationery expense voucher 372. Step 2. Post the net cost into stationery expense. The net stationery cost is $35.25. So we debit stationery expense with $35.25. Reference is voucher 372. Step 3. Post the sales tax into the sales tax account. Sales tax here is $7.05. So we debit sales tax with $7.05. Reference is voucher 372. So voucher 372 creates these postings. Debit stationery expense, $35.25. Debit sales tax, $7.05. Credit petty cash, $42.30. That is the full posting for voucher 372. Part 4. What the petty cash account is showing you. Look at the petty cash account on page 201. It is showing 2 credits because money left petty cash 2 times. Credit for voucher 371 is $25.85. Credit for voucher 372 is $42.30. This is the correct way to treat petty cash. Petty cash is like a small cash box. When money leaves the cash box, we record the full amount leaving. Then we break the cost into the real expense amount and the sales tax amount. Part 5. The key learning point from the rest of the example. This is the most important idea you must keep. For every petty cash payment that includes sales tax, we always do 3 things. 1. We credit petty cash with the total paid. 2. We debit the expense account with the net cost. 3. We debit the sales tax account with the tax part. And we always use the voucher number as a reference because it connects the ledger entry to the physical voucher and receipt. It proves the payment was valid. It makes checking and auditing easy. Final note from the book. The book also mentions that in real life, vouchers might not be posted one by one every time. Sometimes they are posted weekly, sometimes monthly. Often they are posted when petty cash is being topped up, and that is exactly what the next lesson will explain in more detail. Lesson 7 is about one very important routine in petty cash. It is called topping up the float and posting petty cash. In a real business, petty cash is used every day for small payments, so the cash in the petty cash box keeps going down. If we do nothing, the box will eventually become empty. That is why we need a proper system to refill it and record everything correctly. This lesson teaches you how to do that job in a controlled and professional way. What topping up the float means. The float is the amount of cash the business wants to keep in the petty cash box. It is like the target balance for petty cash. When the float is topped up, we are not increasing petty cash forever. We are restoring it back to its normal level. So the goal is simple. Bring the petty cash box back to the float amount and keep the records accurate. Why we must follow a strict topping up procedure. This procedure is not only about getting more cash, it is also a safety and control process. We follow it because it helps us do 4 important things. First, it prevents the petty cash box from running out of money. Second, it makes sure every payment has proof and a document. Third, it helps us detect mistakes quickly. Fourth, it helps prevent theft and fraud. So this lesson is about control, accuracy, and good record keeping. The main idea of Lesson 7. When we top up petty cash, 2 things must happen at the same time. 1. The physical cash in the box must be refilled. 2. The accounting system must be updated. If we only refill the box, but we do not update the records, the accounts become wrong. If we only update the records, but we do not refill the box, the petty cashier cannot make payments. We always do both. The topping up process explains step by step. Step 1. Collect and total all petty cash documents. Before doing anything else, we gather all the paperwork. This includes petty cash vouchers for payments made. It also includes any receipts and supporting documents. And if the organization allows it, it includes any IOU notes. The purpose of this step is to make sure nothing is missing. Step 2. Count the cash left in the petty cash box. Now we count the real notes and coins inside the box. Then we compare the cash we counted with what we expect it to be based on the paperwork. This is a very important control check. If the cash does not match what it should be, we must investigate. Even if the difference is small, small differences can still mean a problem. For example, a missing voucher, or a wrong amount written on a voucher, or cash taken by mistake, or cash taken on purpose. That is why this step protects the business. Step 3. Calculate how much cash is needed to restore the float. After we know the remaining cash in the box, we calculate the top-up amount. This top-up amount is the difference between the float amount and the cash currently left in the box. So we are simply finding how much cash is missing. Step 4. Prepare the request to withdraw cash from the bank. We cannot just take money from the bank without approval. So the business prepares an official request. This is usually done using a check requisition form. This form shows why we need the cash. It also creates a clear authorization trail. Step 5. Withdraw the cash and refill the petty cash box. Once the request is approved, the petty cashier withdraws the cash. When this happens, the petty cashier should also think carefully about denominations. In simple words, the petty cash box should have enough smaller notes and coins. Because petty cash is used for small payments and giving change, so it is not only about the amount, it is also about having usable cash. Step 6. Update the accounting system and post the petty cash transactions below. Now we update the books. This part is essential because the accounts must match reality. When the petty cash is topped up, the bank balance goes down and the petty cash balance goes up. Then the petty cash vouchers are posted into the accounting system. This means we record the expenses properly. For example, stationery expense, travel expense, or sundry expense. If sales tax is involved, it is treated properly as well. Once this is done, the accounting records become complete and accurate. Step 7. File and archive the documents properly. After posting, the documents must be stored safely. This is not optional. It is a key part of the control system. Vouchers and receipts must be kept in order. They must be easy to find later. This helps with checks, audits, and investigations if needed. The most important message to remember from Lesson 7. Lesson 7 teaches you that topping up petty cash is both a cash task and an accounting task. You refill the box, you check for differences, you record the top up, you post the expenses, and you file the documents. If you do these steps properly, petty cash stays organized, safe, and fully controlled. When you are ready, we can do the example that comes with this lesson, step by step, in full detail. Now we will do the full example for Lesson 7.1, topping up the imprest. In this example, the business uses the imprest system. That means the petty cash float must always return to the same fixed amount. The imprest amount in this example is $250. At the end of the period, we do 6 clear steps. We will go step by step, slowly, and we will calculate everything carefully. Step 1. Add up the payment vouchers in the petty cash tin. This means we collect every petty cash voucher that shows a payment was made. Then we total them. Here are the vouchers and their amounts. Travel equals $28.65. Postage equals $6.60. Entertainment equals $81.30. Office supplies and maintenance equals $56.40. Sundry equals $12.30. Sales tax equals $9.87. Now let us add them one by one. Start with travel. Total equals $28.65. Now add postage. $28.65 plus $6.60 equals $35.25. Now add entertainment. $35.25 plus $81.30 equals $116.55. Now add office supplies and maintenance. $116.55 plus $56.40 equals $172.95. Now add sundry. $172.95 plus $12.30 equals $185.25. Now add sales tax. $185.25 plus $9.87 equals $195.12. So the total payments from petty cash equal $195.12. Step 2. Check the amount of cash left in the petty cash tin. In a perfect imprest system, the cash left should be correct and explainable. The rule is very simple. Cash in box equals imprest amount plus any receipts minus total payments. In this example, there's a receipt of $1.10. That means some money was received into petty cash. So we calculate it like this. Imprest amount equals $250. Receipts equal $1.10. Total payments equal $195.12. Now do the math step by step. $250 plus $1.10 equals $251.10. Now subtract the total payments. $251.10 minus $195.12 equals $55.98. So the cash left in the petty cash tin equals $55.98. This is what the petty cashier should physically count in notes and coins. Step 3. Calculate how much cash is needed to top up the petty cash float. The goal is to bring petty cash back to the impressed amount, so we top it up until it returns to $250. There are two correct methods. Both must give the same answer. Method 1. Cash needed equals impressed amount minus cash in box. Impressed amount equals $250. Cash in box equals $55.98. So cash needed equals $250 minus $55.98. Cash needed equals $194.02. Method 2. Cash needed equals total payments minus receipts. Total payments equal $195.12. Receipts equal $1.10. So cash needed equals $195.12 minus $1.10. Cash needed equals $194.02. Perfect. Both methods match. So the top-up required equals $194.02. Now we prepare a check requisition for this amount. A check requisition is simply a request asking the accounts department to prepare a check. On the check requisition, we include date, payable to cash, amount $194.02. Details, petty cash impressed float, signed by petty cashier, authorized by the account supervisor. This authorization is important because we are moving money from the main bank into petty cash. Step 4. Draw the cash from the bank and put it into the petty cash box. After the check is prepared, it is taken to the bank and cashed. The petty cashier then receives cash. But notice something important here. Petty cash must be useful for small payments. So the petty cashier should not take the whole amount in large notes only. They should choose a good mix of notes and coins. In this example, the $194.02 is made up like this: $20 notes, 3 notes, total equals $60. $10 notes, 7 notes, total equals $70. $5 notes, 10 notes, total equals $50. $1 coins, 9 coins, total equals $9. 50-cent coins, 6 coins, total equals $3. 20-cent coins, 5 coins, total equals $1. 10-cent coins, 4 coins, total equals 40 cents. 5-cent coins, 7 coins, total equals 35 cents. 2-cent coins, 10 coins, total equals 20 cents. 1-cent coins, 7 coins, total equals 7 cents. Now we total those quickly to confirm. $60 plus $70 equals $130. $130 plus $50 equals $180. Plus $9 equals $189. Plus $3 equals $192. Plus $1 equals $193. Plus 40 cents equals $193.40. Plus 35 cents equals $193.75. Plus 20 cents equals $193.95. Plus 7 cents equals $194.02. So the cash received is correct. Then this cash is placed into the petty cash box. Step 5. Record the top up in the accounting system. Now we must update the books. This top up is not an expense. It is only a transfer of cash. Money is moving from the bank account to petty cash. So the double entry is debit petty cash account equals $194.02. Credit bank account equals $194.02. This brings petty cash back up to the impressed level. Step 6. Post the vouchers to the accounting system. After topping up, we still must record what the petty cash was spent on. That means we post the vouchers into the correct expense accounts. For example, travel expense is posted to travel. Postage expense is posted to postage. Entertainment is posted to entertainment. Office supplies and maintenance is posted to office supplies and maintenance. Sundry is posted to sundry expense. Sales tax is posted to the sales tax account if the tax can be reclaimed. And the credit entry for posting the payments will reduce petty cash. That completes the full example. Quick recap, so it stays clear in your mind. Total vouchers paid out equals $195.12. Cash left in the tin equals $55.98. Top-up required equals $194.02. After topping up, petty cash returns to $250. Class. Now we will explain Lesson 7.2, Non-Imprest Methods. This lesson is very important because not every business uses the imprest system in the perfect textbook way. Some businesses use simpler methods, especially small businesses. So let us understand what non-imprest methods means. 1. First, remember what the imprest system is. In the imprest system, petty cash has a fixed level. For example, $250. At the end of the week or month, we top it up, and we top it up back to the same fixed amount. So the balance always returns to the same imprest amount. That is why it is called an imprest float. It stays stable. 2. Now, what is a non-imprest method? A non-imprest method means petty cash is not kept at a fixed amount. Instead, the business uses a different approach. The business may simply reimburse petty cash by a set amount whenever it looks low. For example, the business might top up petty cash with $100 each time it runs low. So the top-up is not calculated to return it to a fixed imprest balance. It is just a general refill. That is why it is called non-imprest, because it does not follow the imprest rule of returning to one fixed float amount. 3. An example to make it very clear. Imagine petty cash started at $200. Then during the week, staff spend petty cash on small items. After some spending, petty cash might fall to $40. Now the petty cashier says, we need more cash. So the business gives $100 to petty cash. Now petty cash becomes $140. Notice what happened. It did not return to $200. It just increased by $100. So the petty cash level is changing and moving up and down. It is not fixed. That is a non-imprest method. 4. Is this method allowed? Yes, it can be acceptable, but only if it is controlled properly. The book explains that some companies do not operate a strict imprest system. They may reimburse petty cash with a set amount whenever the float gets low. This can still work well if two things happen. 1. The petty cash is balanced and checked regularly. 2. The accounting system is written up correctly. So the main point is not only the method, the main point is control and recording. 5. What is the advantage of non-imprest methods? The advantage is simplicity. It is easy to run. The petty cashier does not need to calculate a perfect top-up every time. They just request a standard amount, like $100. This can save time in a very small business. 6. What is the disadvantage and the risk? The disadvantage is that control becomes weaker. Because petty cash does not return to a fixed balance, it is harder to notice problems quickly. For example, in the imprest system, you expect cash in box plus vouchers equals imprest amount. So if the totals do not match, you immediately know something is wrong. But in a non-imprest system, the expected balance is not fixed. So if money is missing or mistakes happen, it may not be noticed quickly. That is the risk. This is why, even in a non-imprest method, the business must keep good records. 7. The most important message for students. Whether a business uses imprest or non-imprest methods, these rules must always be followed. Every petty cash payment must have a voucher. Every voucher must be supported by a receipt whenever possible. The petty cashier must keep the cash safe. The petty cash total must be checked regularly. If those controls are followed, the system can still work. Final classroom summary. Non-imprest methods mean petty cash is topped up by a standard amount, not back to a fixed imprest total. It is simpler and quicker. But it can be less controlled unless regular balancing and proper accounting records are maintained. Students, now we will cover two short but very important lessons. We will explain Lesson 7.3, and then we will explain Lesson 7.4. I will explain them slowly and clearly, like in a real classroom. Lesson 7.3. Drawing cash against a crossed check. First, let us remind ourselves what a check is. A check is a paper instruction from the business to the bank. It tells the bank to pay money. Now, a crossed check is a special type of check. A crossed check usually has two lines across it. Those lines mean something very important. They mean the check should not be paid out as cash. Instead, it should normally be paid into a bank account. So the bank should transfer the money into an account, not hand out notes and coins. Now you might ask, why do we cross a check? We cross a check for safety. Because if someone steals the check, they cannot easily take cash from the bank. The check must go into a bank account, and that is easier to trace. So crossing helps reduce theft and fraud. Now here is the key part of this lesson. Sometimes, when a company representative goes to the bank, the cashier may still give cash, even if the check is crossed. Why would that happen? Because in real life, banks sometimes know their customers well. They may recognize the representative. They may trust the business, so they may allow the business to cash it. But you must understand this clearly. This is not the normal rule. This is an exception. It happens because of practical business and banking needs. Sometimes the petty cashier urgently needs notes and coins, so the bank may cooperate. So the lesson is teaching you two ideas at the same time. Idea 1. A crossed check is meant to be paid into an account, not cashed. Idea 2. In practice, a bank may still cash it for a trusted business representative. Lesson 7.4. Archive records. Now we move to a very important control topic. Archive records means keeping the petty cash documents safely after you have used them. Let us think about what happens in petty cash. Every time petty cash is paid out, a voucher is prepared, and usually a receipt is attached to that voucher. Over time, the petty cash box will contain many vouchers and receipts, especially if the business is busy. But once the vouchers have been entered into the accounting system, we do not keep them inside the petty cash box forever. So what do? We take the completed vouchers and receipts out of the box, and we store them properly. That is what archiving means. Now, why is archiving so important? Because the business must be able to prove that each payment was real and authorized. Also, an auditor may need to check any voucher later. Or the business may need evidence for tax or internal checks, so the documents must be kept safe and organized. The book explains that vouchers should not be thrown away. They should be kept for at least 7 years. That is a long time, but it is necessary for legal and audit reasons. Now let us talk about how to archive them properly. A good system is usually like this. 1. Keep each voucher together with its receipt. Do not separate them. 2. Keep them in number sequence, because voucher numbers are used to track each payment. 3. Put them into box files or folders or containers and label them clearly. For example, the label should show the voucher number range and it should show the time period covered. 4. Keep the records until the accounts for that year have been audited. After the audit is complete, they may be moved to long-term storage. So the most important point is simple. Petty cash documents must be stored in an organized way so that any voucher can be found quickly in the future. Quick summary to finish. Lesson 7.3 teaches us about crossed checks. Crossed checks are meant to go into a bank account, not be cashed. But in practice, banks may sometimes cash them for trusted business customers. Lesson 7.4 teaches us about archive records. After posting petty cash vouchers to the accounting system, we store vouchers and receipts safely. We keep them in order, well labeled, and for at least 7 years.